Good morning to all of you. This is a session on fire insurance, basics of fire insurance, types of policies including industrial all risk and further business interruption policy FLOP. This session may be useful for general insurance public sector employees, promotion exam candidates. It may be useful for others who are seeking a career in fire insurance. So I am trying to touch upon the basic or important points, but I believe that you do have some basic knowledge in fire tariff. So I am not going to the scratches of policy or the elementary level, but which are all the important points to be noted and the conditions in the policy, how the claims are considered, and then how business interruption policies are dealt with. Let's go to the topic.
Insurance policy is actually a commercial contract. Fire policy also is a commercial contract specifying who is insured, what is insured, against what insurance is made. We call it as subject matter. And as you know, insurance is based on certain basic principles like indemnity, insurable interest, utmost good faith. So these principles of insurance are also applicable to fire insurance. For example, indemnity. Indemnity is the essence of an insurance contract. Subrogation and contribution are corollaries to principle of indemnity. And fire insurance, particularly, it is based on strict indemnity principle. In the sense, in the event of a loss or damage, what is payable under fire policy is based on strict indemnity. That means insurance company will pay the actual loss suffered by the claimant, not 1 rupee more or 1 rupee less. Other principles like insurable interest, that means the ownership of the property which is covered under fire insurance, it should exist at the time of taking the policy, during its currency, and at the time of loss also. So a person can take fire insurance only if he is having absolute ownership of the property, and he should prove the ownership even at the time of loss. Now coming to utmost good faith. Utmost good faith is the duty of disclosure of material facts. It should exist at the time of taking the policy and during the currency of the policy period also it should be there. So this is particularly mentioned in condition number 3. Now this duty of utmost good faith becomes contractual duty as per declaration in the proposal form. So when the proposer declares certain material facts in the proposal form, and when he signs that whatever stated is true, then this utmost good faith becomes a contractual duty. Now fire insurance, it gives protection to physical asset, especially land based and immovable property. So there are two qualifications. One is the property should be land based, other one is it should be immovable. So in fire insurance, you can cover only land-based properties. So if the property is situated in water or in air, then you cannot cover it under fire policy. For example, offshore risks, construction in sea, like SPM. So these things you cannot cover it under fire policy. Again, the property should be immovable. Immovable. So property which are continuously moving, like a motor car or a ship or an aeroplane, these properties cannot be covered under fire insurance. See, fire insurance normally policy is issued to a specified location. So coverage is confined to a particular location. When the property is taken out of this location or premises, the policy automatically ceases. Of course, that property can move within the location, though I have told you it is immovable property. It can move within the location, not outside location. This policy compensates the insured person if the property is destroyed or damaged by happening of any event that is spelled out in the fire insurance contract. Fire insurance policy is actually listed perils policy. As you know, there are two types of policies. One is listed perils policy, the other one is all risk policy. So in a listed perils policy, the perils covered are listed. For example, in standard fire and special perils policy, there are 12 perils listed. So coverage is given against these 12 perils only. So in the event of a loss, it is the duty of the insured to prove that his property is damaged by one of these 12 perils. Whereas in the case of an all risk policy like industrial all risk policy, it is the duty of the insurance company to prove that the property is damaged by one of the exclusions, so the claim is not admissible. Basically, the all risk policy does not specify what is covered. It always specifies what is not covered. So this policy is driven by exclusions. So exclusions are listed in the policy, not the perils. So the basic difference is in onus of proof.
Let us see some key points in fire policy. Full premium to be paid in advance. That means there is no installment clause. Full property is to be insured. Partial insurance is not allowed. It is not permissible to issue a policy covering only certain portions of the building. Notwithstanding this, the plinth and foundation or only the foundation of a building may be excluded. So if the insured wants to cover a building, the entire building to be covered, but he is free to exclude the plinth and foundation. Similarly, to issue a policy covering only specified machinery except boilers, parts of machine or accessories thereof housed in the same block or building. So if the insured wants to cover machinery, he has to cover the entire machinery except boilers. If portions of a building or machinery are under different ownership, it is permissible for each owner to insure separately, but to the full extent of his insurable interest on the building or machinery. In such cases, insured's interest shall be clearly defined in the policy. So in a nutshell, in fire policy, within one compound or one location, insured cannot select part of machinery or part of building or part of stock to be insured. He should insure as a whole. But of course, he can cover only building if he wants without taking insurance for plant and machinery and stock. He can cover only plant and machinery if he wants without taking cover for stock or building. Similar is the case with the stock. But once he decides to go to insure plant and machinery, the entire plant and machinery to be covered except boilers. Boilers he can exclude. That is why in fire policies it is enough to specify only the nomenclature of the property covered, such as building, plant and machinery, stocks related to the trade of the insured. It is not required to specify each property separately with the serial number or year of make or the type of stock. Those things are not required. For example, in the case of a textile industry, it is enough to state that stock related to trade of textile industry. So it will cover all types of stocks starting from cotton, yarn, waste cotton, packing material, everything will be covered, cloth, everything, whatever available in the plan will be covered under the item stock. But instead, if you start specifying stock of cotton, stock of yarn, stock of waste cotton separately, then it means that the other materials are not covered. So there is a danger in giving more and more specification in the policy. So it is better to have a common nomenclature and specify it. Anyway, there is no selection allowed. But if the insurable interest differs, for example, a bank is having insurable interest only on a particular machine, then he can cover only that machine. So it is based on insured can take the policy to the extent of his insurable interest, but to the full extent of his insurable interest. Fire policies are usually issued for 12 months except dwellings. Dwellings can be given for more than 12 months. And fire is a D-tariff product now. The basic rates are guided by STFI fire tariff. However, companies are free to apply discounts as per products filed with the regulator. Fire rate comprises of Flexa, RSMD and STFI rates. Currently, the rates are based on IIB rates published in December 2019. And I think you are aware that up to sum insured of 50 crore per location, now SFSP policies have been abolished. Instead of that, there are two policies, Bharat Sukshma Udyam Suraksha and Bharat Laghu Udyam Suraksha. Bharat Sukshma Udyam Suraksha is issued up to 5 crore. Bharat Laghu Udyam Suraksha is issued from 5 crore to 50 crore. More than 50 crore, this SFSP will prevail. And for all types of residential dwellings, there is another policy known as Bharat Griha Raksha, that is irrespective of the sum insured. Anyway, the discussion of those policies are not coming under the purview of this particular presentation. So I am keeping it aside and moving on to SFSP. Fire policy normally issued on three bases: reinstatement value basis, market value basis, and valued policy. Reinstatement value basis and market value basis we will see at a later stage. Coming to valued policies, certain items like curious, work of art, manuscripts, obsolete machinery, where the market value cannot be determined at all. So we depend on a valuation certificate, and based on this valuation certificate, agreed value policies are issued. All other properties under fire policy are covered based on RIB basis or market value basis. Now, as I told you earlier, long-term policies can be issued for more than 12 months only in the case of dwellings. So nowadays it is replaced by Bharat Griha Raksha policy. Now mid-term cover for STFI and or RSMD perils. The payment of premium in cash or by draft. So if the policy is issued without STFI and RSMD, and in between the policy period, if somebody wants to have STFI and RSMD cover, then payment of premium should be in cash or by draft. Additional premium shall not be adjusted against existing CD or bank guarantee. Mid-term cover shall be granted for the entire property at one complex compound or location, covering the entire interest of the insured under one or more policies. Insured shall not have any option for selection. So entire property to be covered under STFI and RSMD periods. Cover shall commence 15 days after the receipt of the premium. So there is a waiting period of 15 days. And minimum premium for fire policy is 100 rupees, except for tiny sector industries where it can be of 50 rupees. And section 3 also, it is 50 rupees. There is a concept of types of construction: kacha construction, pakka construction. Pakka construction means anything other than kacha. Kacha means building having walls or roofs of wooden planks or thatched leaves or grass or hair. This can be treated as kacha construction for rating purpose. An additional premium, earlier it was 4 per milli, now it is de-tariffed. So each company is having its own rating pattern. And pakka construction means which is built up of brick or RCC construction or GA roofing. These are all treated as pakka. Now how to cancel the policy? At the option of the insured, if the policy is cancelled by the insured, retention of premium shall be at short period scale for the period the policy has been in force, subject to the retention of minimum premium by the insurer. So let us say if the insured wants to cancel a policy after 3 months, then the insurer will retain premium for the 3 months on short period scale, not on pro rata scale, and balance will be refunded. But if the policy is replaced with the same insurer by a new annual one covering the identical property, refund of premium may be allowed on pro rata basis. See, some cases insured may want to cancel the policy to streamline that policy with other policies. So in that case, if the policy is renewed with the same insurer, with the same sum insured or more than the earlier sum insured, then pro rata refund can be allowed. But during the renewal of the policy, like when the policy is replaced, if the sum insured is lesser than the original sum insured, then the premium will be calculated on short period scale. If a policy is cancelled on account of a government order or on a completion of a building in course of construction, where buildings are demolished pro rata refund of premium may be allowed. So building in course of construction policy is converted to a new risk, then pro rata premium can be, refund can be allowed. Again, if the policy is cancelled at the option of the insurer, refund of premium shall be on pro rata basis for the unexpired term. How to revise the sum insured in the policy? If it is an increasing sum insured, premium is charged on pro rata basis. If it is decreasing sum insured, then premium is charged on short period scale. In a fire insurance policy or standard fire and special perils policy, there are 12 perils covered, 13 exclusions, 14 add-on covers, and 15 conditions. The fire policy is a listed perils policy. If you see, we normally issue two types of policies. One is listed perils policy, like a SFSP policy or MBD policy, and then the all risk policy, like an EA policy or IAR policy. So in a listed perils policy, the perils covered are listed along with the standard exclusions. And in an all risk policy, perils covered are not listed, only exclusions are listed. The basic difference is that in the event of a damage or claim to listed perils policy, it is the duty of the insured to prove that his property is damaged by one of the perils covered under the policy. Whereas in an all risk policy, it is the duty of the insurer to prove that the material or subject matter is damaged by a peril which is not covered under the policy. So it is coming as an exclusion, and hence the claim is not admissible. So in an all risk policy, it will be very difficult to prove that property is damaged by excluded perils. So almost all perils are covered, like an IAR policy or electronic equipment insurance, or in engineering insurance, you would have heard of storage cum erection or contractors all risk policy. Whereas an SFSP policy is a listed peril policy, so insured should prove that his subject matter is damaged by one of these perils. Total 12 perils are covered under the policy, like fire, lightning. We will explain it later. There are 13 exclusions, 14 add-on covers. Actually, add-on covers are 15. One more add-on, molten material spillage, was added to the policy at a later date by Tariff Advisory Committee. And there are 15 conditions, 12, 13, 14, 15. Just to remember, these are the perils, exclusions, add-on covers and conditions available in fire insurance.
Now coming to what is covered or what can be covered under fire policy. What can be the subject matter under a fire policy? All buildings can be covered, machinery including spares, any type of stock of raw materials, semi-finished goods, process materials, stores, FFF, furniture, fixture, fittings. So any immovable property, land-based property can be covered, but normally property is described with certain specifications like the nomenclature, like building, machinery, stock, furniture, electrical installations, etc. A fire insurance policy covers any physical asset present in an identified location. So it is a location specific policy. How to specify the sum insured in fire policy? Sum insured should include building, plant and machinery, electrical installations, FFF, stock, and specific items. See, the speciality of fire policy is that it does not allow selection of risk. So, if in a premises, if there are several buildings and a lot of plant and machinery and stock, furnitures, so if the insured wants to take cover for building, then he has to cover the entire building within the location. He cannot select between the buildings. Similarly, if he wants to cover plant and machinery, the entire plant and machinery within the locations are to be covered. There is one exception, a boiler can be excluded. But of course, a particular insured, if he wants to cover only plant and machinery, not the building, it is allowed. Let us assume a bank is given loan for stock. So the bank's interest, rather insurable interest, is limited to stock. So banks can take a policy only for stock. So based on the insurable interest, the client can take a policy building alone, plant and machinery alone, stock alone, or maybe combined together. But if he is covering stock, the entire stock within the premises to be covered. Similarly, if he covers building, the entire building within the premises to be covered. Selection is not allowed. So, since selection is not allowed, there is no point in mentioning the type of building, type of plant and machinery, its specification, serial number, make. Those things are not required in fire policy. If somebody is interested to mention, they can mention. But still, the advantage is that once you state building, or if let us assume a textile industry, if the client has specified that stock, then whatever stock within the premises deemed to be covered. It can be stock of cotton, stock of yarn, or stock in process, stock of waste cotton. It can be packing material. Everything is covered. But if you try to specify something in the policy, for example, if we specify stock of cotton and stock of yarn, that means that in the event of a claim, only yarn and cotton are payable. So packing material will not be payable. Waste cotton can be excluded. Stock in process can be excluded. So it is better to give this nomenclature as such in the policy. There should be a common name like stock related to the trade of the insured, all buildings within the location, all plant and machinery within the location. Like
in a fire policy, sum insured can be specified on three bases. One, reinstatement value basis. Second one, market value basis. Third one, agreed value basis. Reinstatement value means for a building it is current construction cost. For a plant and machinery it is current new replacement value. So this method is applicable for all the properties which are covered under fire insurance except stocks. Stocks are always covered under market value basis. Take an example of a building. How to find the current construction cost? Current construction cost means the cost incurred by the insured to reconstruct the building after the loss. So the value to be specified in the policy as sum insured, it should be equal to the current construction cost. In the case of a machinery, it should be the current replacement value, the value with which you can buy that machine as on today. Now coming to market value, the concept of market value in fire insurance is different from what is there in motor insurance. In fire insurance, market value is determined by first finding the reinstatement value, then deducting the depreciation from it. So market value is equal to reinstatement value minus depreciation. So there is no other formula to be used for market value. So it is not actually the value available in the market. First, you have to find out the reinstatement value, that means current construction cost or current replacement cost, then appropriate depreciation to be deducted from that value based on the usage, wear and tear of the equipment or the building. Normally, depreciation is determined by the surveyor based on the type of equipment or type of building, etc. And after deduction of depreciation from reinstatement value, what is available there is the market value. This is for building, plant and machinery, FFF, electrical installation, or all those types of properties. Whereas in stock, for example, if it is a commodity, then as usual it is the market price. For example, sugar, rubber, what is the market price of sugar as on date of loss? So that we have to see. If these stocks are exclusive to the particular trade of the insured, then the value can be arrived at by the purchase cost of the stock. So this is the major difference. Now if the insured opts for reinstatement value basis, then in the event of damage he should reinstate the property. And in fire insurance policy there is a scope of 12 months reinstatement period. So insured should replace or reinstate the property within these 12 months. He can request for further extension of this period
That depends on the insurer. Based on insurer's approval only, this 12 months can be extended, but normal time period allowed is 12 months. So if the policy issued is based on reinstatement value, or if RIV clause is attached with the policy, then in the event of a loss, insured should reinstate the property within 12 months, and the reinstatement value of the property or building as on date of reinstatement will be compared with the sum insured in the policy to arrive at the underinsurance. So in RIV policies, underinsurance is calculated based on the RIV reinstatement value as on date of reinstatement, not as on date of loss. So if the RIV is more than the value at risk, then average clause or underinsurance is applicable. So all proofs of reinstatement to be submitted to the insurance company, such as bills, invoices, payment proof. Only after satisfactory submission of these documents, insurance company normally allow a claim on RIV basis. If insured is not submitting these documents, or if insured fails to reinstate the property within 12 months, or if insured decide not to reinstate the property after the damage, in all these situations, insurance company will settle the claim on market value basis. So even though the policy is issued on RIV basis, there is an option to settle the claim on market value. Now in market value policies, when the policy is issued on market value, then after the loss, it is not mandatory for the insured to reinstate the property. He can just submit the quotations of the damaged item to prove its value, then he can get the claim. But of course, market value policy, in market value policies, the claim will be settled on market value. That means RIV minus depreciation. Now the third type of policy is agreed value policies, which are issued for properties for which market value cannot be determined. For example, bullion, gold bar or silver utensils, silver items, works of art, drawings, or second-hand machinery, precious stones. Wherever the value cannot be ascertained, normally then agreed value policies can be given, but there should be a valuation certificate based on which the policies will be issued. In the event of a claim, the value specified in the policy will be settled.
So this is a simple example. For example, a building with an area of 1000 square feet. It is already 5 years old. Let us assume replacement value is 15 lakhs. Now compare the two methods, RIV and market value. So value of building with 1000 square feet, RIV basis is 15 lakhs. Let us assume market value is 13.5 lakhs. That means 1.5 lakhs, 10% depreciation, 2% per year already applied. So that is the market value. Now let us assume sum insured, the first insured has taken 12 lakhs, second insured has taken 10.5 lakhs. And there is a loss of 5 lakhs in both the cases. So how the claim will be worked out? So current new replacement value or RIV is 5 lakhs. So both cases the claim settlement starts with reinstatement value. First you have to find out what is the current construction cost in both the methods. So it is 5 lakhs. Now you have to apply depreciation. So if the insured has taken a policy on RIV basis, then depreciation is 0. So when he has taken on market value basis, a depreciation, let us say 10% is applied. So 5 minus 50,000, it is 4.5 lakhs. So amount after depreciation in RIV is 5 lakhs again. In market value it is 4.5 lakhs. Now let us assume there is a salvage of 10,000. So it becomes RIV basis 4.9 and MV basis it is 4.4. Now comes the average clause. Average clause otherwise known as underinsurance. So if value of the property or value at risk, if it is less than the sum insured, then that proportion insured has to bear the loss. That is the concept of underinsurance. So underinsurance is calculated by multiplying the amount of loss with the sum to be insured. What should have been the sum insured divided by sum insured. So here in the first case, RIV case, the loss is 4.9 lakhs into sum insured is only 12 lakhs, sum to be insured is 15 lakhs. I think I have told you the reverse. It should be loss into sum insured by sum to be insured. Loss into sum insured divided by sum to be insured. So in the first case it is 4.9 into 12 lakhs is the sum insured divided by 15 lakhs is the sum that to be insured, because that is the RIV. Now in the second case, MV basis, it is 4.4 lakhs into 10.5, which is the sum insured divided by 13.5. So it should have been 13.5 on market value basis. Now amount after average close becomes 3.92 and 3.42. So though the starting point is same 5 lakhs, ultimately on market value basis he is getting after excess only 3.3, whereas in RIV he is getting 3.82 even with an underinsurance. So there is a difference. So ultimately the intention of RIV policy or RIV clause is to indemnify the insured to the full extent. So whatever he is incurring for current reconstruction, 100% loss is indemnified by the insurance company. Whereas in market value basis, he will have to bear a portion, whatever depreciation he will have to bear.
Let us see this comparison of RIV and MV policies. So reinstatement value policy is normally issued to building, plant and machinery, furniture, fixture and fittings only, and not for stocks. Market value policy is normally, it can be issued for stocks as well as all other properties. So sum insured will be on RIV basis. For market value policy, it will be on market value basis. Now for adequacy of sum insured, average close or under insurance, the value of the item will be compared with the value at risk as on date of reinstatement for RIV policy. For market value policy, it is always on date of loss. So this is a major difference. Now when RIV policy is issued, claims are settled on RIV, or it can be settled on market value if the insured opt to do it, or insured is not going for reinstatement, or insured fails to do the reinstatement. Whereas in market value policy, settlement will be always on market value, and it is arrived at by RIV minus depreciation. Now in the event of a claim, cost of replacement or reinstatement of machinery or building to a condition equal to but not better than its condition when new, improvement factor if any will be deducted. So the same type of machine to be replaced, or the building also to be the same area or specification, improvement factor if any will be deducted. Settlement on market value basis is RIV minus depreciation. So though the policy is issued on market value basis, for a claim settlement purpose, it is always first we have to find out what is RIV. You cannot straight away go to market value, especially in cases of property and not stocks. Now in the event of RIV policy, insured has to intimate the insurer the intentions to reinstate within 6 months from date of loss. And market value policy, reinstatement is not mandatory. And reinstatement should be completed within 12 months from date of loss. Market value, it is not applicable. Further extension of reinstatement period can be allowed by the insurance company for 12 months. See, while allowing an extension of reinstatement, normally insurance company specify a condition stating that by way of extension, the liability of the insurance company is no way increased. That means whatever purchase invoices or the cost they are going to incur for reinstatement of the property should be frozen before 12 months. If any additional expenditure incurred after 12 months, because of that delay, insurance company will not be responsible. If reinstatement is not carried out, then though the policy is on RIV basis, settlement can be done on market value. And premium rate to be charged on RIV basis sum insured, whereas in market value policy it is market value basis sum insured. And indemnity, I told you earlier, fire policy is based on strict indemnity principle. There are certain instances where fire policy deviates from strict indemnity principle. This is one of those incidences. In RIV policy, actually the insured is brought back to a condition which is better than before the loss. So it is treated as a variation from pure indemnity, whereas in market value policies it is a strict indemnity. For example, a building which is 10 years old, so he has been using that building, so natural wear and tear will be there in the building. Now it is policy is issued on RIV basis and there is a damage, insurance company will pay the full reinstatement cost. So the claimant or insured is getting a new building. So it is what he has lost is 10-year-old building. So he is in an advantageous position. That is why we are telling it is a variation from the strict indemnity principle. The other instance where fire policy deviates from strict indemnity principle is contract price insurance clause, whereby insurance company settles for the stock more than its actual incurred value, or whatever expenses he has incurred to manufacture that stock plus net profit expected from that sale of goods, that is also settled. So insured is actually earning a profit by attaching this contract price insurance clause. So that is why it is known as, like, it is told as variation from pure indemnity principle. Now let us see fire insurance perils. The first peril is fire. So what is fire? Actual burning by accidental means. So there are two words. One is actual burning. There should be actual burning. Burning means flame should be there, and then it should be accidental. So burning is chemically, it's a combustion process, combination with oxygen, but all combustion process are not payable under fire policy. When wherever materials are react with oxygen, it is known as combustion. Definitely most of them will liberate heat, but insurance companies' interest is limited to the area where light is emitted. Heat and light are emitted. So wherever light is also emitted, you can see a flame. In that case, it is admitted as a fire in insurance. And this fire should be accidental in nature. And there are certain exclusions. It's on fermentation, natural heating, or spontaneous combustion. So these are not covered under normal fire policy. Fermentation, natural heating, or spontaneous combustion. So these are treated as natural phenomena and gradual phenomena. So it is not treated as accidental. Of course, there are some add-on covers available to cover spontaneous combustion. Now it's undergoing heating or drying process. A property which is undergoing heating or drying process is excluded. For example, a bread is baked in an oven. So here the property undergoing heating or drying is the bread, not the oven. So in the event of a fire accident, bread will not be payable, but oven and all allied equipments which also got damaged in fire can be paid. But if a property is undergoing heating process and it is damaged by fire, then it is not payable. And by order of public authority, if the government orders that a building to be demolished or a property to be burned, then it is not payable under fire policy. Now expenses payable following a fire. Water damage while extinguishing, that means firefighting expenses, and damage by firefighters. Sometimes firefighters break the wall or window so that fighting can be done easily. Then whatever smoke damage, whenever fire occurs, definitely there will be smoke, and this smoke can cause damage to walls or paintings, so that is also payable. Property demolished to avoid spread of fire. So if we demolish certain property so that fire is not spread to the adjoining properties or other blocks, then those demolition is also payable. Falling structures, after the fire happened, the structure falls. And then any loss minimization expenses or firefighting expenses, material segregation or removal to minimize the loss, so these expenses are payable. Another important thing to remember is that in the event of a fire, if the insured tries to minimize the loss and he is removing some material from the burning building, let us assume these materials which are removed kept at a particular area and further damaged by some other natural calamity, let us say rain damage or flood damage. So it is known as aggravation of loss. So this aggravation following a fire is always admissible under the policy because it is beyond the control of the insured. He has removed those property to save it from fire, but unfortunately further it was damaged by natural calamity. So that should be payable. Now second peril covered under fire policy is lightning. Here there is no explanation in the tariff, but when you see the exclusion number 7, when you read along with exclusion number 7, you can understand that what is covered under fire insurance policy is only direct damage of lightning. There can be two effect or damages of lightning. One is direct, other one is indirect. Direct damage means the peril, that is lightning, should touch the subject matter. Lightning should pass through the subject matter. If the lightning passes through a building, then a crack will be developed. If it passes through a more distant property, then the property itself may burn. Due to that resistance it is applied for the high voltage. Lightning is nothing but a high voltage, transmission of high voltage from air to earth. So when it passes through the building can crack. When it passes through, let us say, coconut tree, the tree can burn. So it is based on the nature of the property. Anyway, whatever damages happening due to direct impact of lightning is payable. But there is an indirect impact. For example, a TV is damaged when there was a lightning strike outside. So lightning struck on the outside distribution transformer. This causes a surge in voltage, and this surge in voltage causes a damage to household, let us say TV, fridge or whatever it is. But this effect is termed as indirect effect. Lightning as a peril has not touched the particular subject matter at all. Lightning was struck on some other area, but an indirect effect of high voltage has damaged the property or subject matter covered under the policy. It is not payable as per exclusion number 7. It is excluded. So only direct effect of lightning is covered. Here we have to remember that if direct effect can be proved by the visible marks, charring marks or circumstantial evidences, it is proved that there was a direct impact of lightning, then all types of properties are covered under that, whether it is an electrical machine or electronic machine or stock or building, whatever it is. If you can prove that there is a direct impact of lightning, then it is payable. But if it is not a direct impact, then it is not payable under fire policy. Next is explosion and implosion. See, explosion is sudden or violent burst outward due to built up of internal pressure. So within a vessel or an equipment, if the pressure is built up, pressure is more than the atmospheric pressure, 1.03 kilogram per centimeter square, there is atmospheric pressure. If due to any reason the pressure is more than the atmospheric pressure, then there is a chance of bursting or explosion. When it explodes, an equipment or a vessel explodes, naturally it will cause damage to all the surrounding properties. It is known as concussion damages. So these concussion damages are payable under fire policy. and just reverse is known as implosion. When there is a vacuum inside, due to outside pressure, the property can buckle or collapse due to external pressure, or it will move inwards. So this is known as implosion. This is also payable under fire policy. What is excluded under this peril is damage to boilers, except domestic boiler or pressure cooker. And another exclusion is centrifugal explosion. So boiler is the item or the equipment where water is heated to get steam. Boiler will always be under huge pressure compared to the outside pressure. So there is every chance that a failure can happen or explosion can happen in a boiler compared to other machines or other equipments. So here what is excluded is damage to boiler. If a boiler explodes, it creates damage to itself. Boiler will be damaged, and due to pressure, transmission of pressure waves, all the surrounding vicinity, surrounding properties will be damaged. This is known as concussion damages. So in a fire policy, all the surrounding property damages are payable except the damage to boiler. To cover the damage to boiler, there is another policy known as boiler and pressure plant policy. So fire policy excludes damage to boilers. Of course, there is an exclusion on exclusion, that means it is covered, which is domestic boiler. If a pressure cooker explodes, then even that cooker is also payable if fire policy is taken. Next is aircraft damage. So aircraft damage, everybody remember the September 11 incident in America, the Twin Towers. So damage caused by aircraft, rockets, balloons, satellites. So any aerial devices due to damage due to hitting of any aerial devices are payable under this fire policy. There is one exclusion, damage by pressure waves. So when an aeroplane moves with supersonic speeds, that means sound speed more than the sound, then it can create pressure waves in the atmosphere, and these pressure waves or transmission of pressure waves can cause damage to glass panes of buildings. It can break. So these type of damages are not payable. So here also the aerial devices or the aircraft should touch the property which is covered under the policy. Next is RSMD, riot, strike, malicious damage. So what is covered under RSMD is direct visible physical loss by external violent means. That means when there is a riot or strike, there should be a physical loss. See, there can be other losses as well. If people are on strike, the industry cannot function. So there cannot be any production. This will cause consequential losses, loss of turnover, loss of GP. So those things are not payable under fire policy. What is covered under fire policy is only physical loss or damage by the people who are involved in strike or riot or malicious damage. So exclusions are cessation, retarding or interruption of work, dispossession from, confiscation by government and unlawful occupation, burglary, theft, larceny, etc. during malicious act. So this last portion is important. What is not covered here? Burglary, theft, larceny, etc. during malicious act. So here we are talking about three perils: riot, strike and malicious damage. So burglary, theft and larceny happening during malicious act is not covered. But burglary, theft or larceny happening during riot and strike is covered. Why we are telling like this? If you see the definition, it is direct visible physical loss or damage by external violent means. So physical loss also covered. So if the rioter entering into a premises and he is creating havoc or damage into the premises, then it is, of course, it is payable because it's a physical damage. But if he lifts the equipment, if he swindles the equipment, if he takes away the equipment, then can we tell it is not payable? So the rioter who is creating the physical damage or he is lifting the equipment as a form of burglary or theft, that is also payable under fire policy. Similar is the case with strike. But in malicious damage, see, malicious damage normally one or two people are involved. not a very big group. So burglary itself is a malicious act. So here, though malicious damage is covered, we are excluding burglary, theft or larceny during this malicious act. There is a separate policy, burglary policy, to cover burglary, and burglary itself is a malicious act. So there is no differentiation. So it can be covered under a separate policy. So here only malicious physical damage to property is covered, not physical loss. See, riot or strike. Riot means public disturbance by a group of 6 or more. Physical damage inflicted by striking worker only covered. Terrorism is a separate add-on covers. Terrorism is also a form of or activism performed by a group of people intentionally causing damage to the public properties. But terrorism is a separate add-on cover under the policy, and the damage will be treated as terrorism only when it is declared by government. Next is STFI: storm, cyclone, typhoon, tempest, hurricane, tornado. So these are all winds with different speed and intensity. It is usually called by different names based on the geographical area, wind speed, etc. But all the damages caused by these winds, high speed winds, are covered under the policy. Now flood and inundation. So flood means like natural overflow of natural resources, like a lake or river. When the water enters from river into the property, it is known as flood. Now inundation is again stagnation of water into the property covered under the policy by various means. It can be heavy rain, it can be water from outside water bodies, it can be even a leakage from a water tank or a leakage from a pipeline. It can cause inundation. So these things are covered under fire policy. And earthquake is a separate add-on cover. See, tsunami, you would have heard the word. Tsunami is covered if both EQ and STFI are covered. So there is no separate coverage as such for tsunami. If EQ add-on is taken, STFI peril is also there, then tsunami is also covered.
So next peril is impact damage. Direct contact by rail, road, vehicle, animal not owned by insured. So if there is a damage to the property covered under the policy by direct contact by rail, road, vehicle or animal, it should not be owned by insured. Then it is covered under the policy. So if it is owned by the insured and causing damage, there is an add-on cover, impact damage by owned railroad vehicle or forklift or other equipments. Next is subsidence landslide including rock slides. So this is a natural catastrophe. When in the event of heavy rainfall, there can be subsidence, landslide and rock slide. Exclusion is normal cracking, settlement of coastal or river erosion, defective design, workmanship, materials, demolition, construction, alteration, etc. See, normally in the event of a new structure, there can be subsidence because of the settlement of soil. So that is not covered under the policy. Only accidental subsidence and then landslide and rock slide are covered under the policy. Next peril is bursting and or overflowing of water tanks, apparatus and pipes. So naturally, if there is a bursting or overflowing of water tanks, it will cause inundation and it is payable under the policy. Missile testing operations by Government of India, if it causes damage to the subject matter, that is payable under the policy. Then leakage from automatic sprinkler installation, excluding damage due to repairs, alteration to building and sprinkler installation, existing defects, etc. are not payable. See, sprinkler is a firefighting equipment which is installed in areas of high value or where the origin of fire is possible. So in the event of a small fire, this sprinkler is having a sensor or a bulb which detects the heat and then naturally it will break, and this bulb is connected to a high pressurized water line. So water will be sprayed into that particular area. So in the event of a fire can be doused at the initial stage itself before spreading. So that is the use of a sprinkler. So the intention is to entertain the
installation of these type of firefighting equipments. So in the event of a leakage from the sprinkler, sometimes without fire, the bulb will sense it wrongly and the bulb will break and water will be sprayed and stock or machinery will be damaged. So this is a leakage. It is treated as a leakage or malfunction. It is payable under the policy. What is excluded is if there is a damage during repair or alteration. That time if there is a damage, then it is not payable. Another peril, last peril is bush fire. See, there is a differentiation between bush fire and forest fire. See, forest fire is the fire spreading to the property covered under the policy from an area which is designated as forest by government. All other area, when the fire spread from those areas, it is known as bush fire. So forest fire is an exclusion under the policy, whereas bush fire is covered. Forest fire cover can be given as an add-on cover.
Now let us see fire insurance exclusions. First one is excess. This excess is the fixed amount that is deducted from each and every claim. Now the excess applicable is as per 1st of April 2011 circular. It is not changed till now. So it is based on the sum insured per location. If the sum insured per location is up to 10 crore, then 5% of the claim amount subject to minimum of 10,000. If sum insured per location is 100 crore, then the amount becomes 25,000. Similarly, if sum insured is above 2,500, then it becomes 50 lakhs. Next is loss of stocks in cold storage by change of temperature. So if there is a peril such as fire or flood, it will affect the plant and machinery which is keeping the cold storage at low temperatures. So when there is a damage to this machinery, naturally the temperature will rise inside the cold storage because that refrigerating machinery is damaged. Then the stocks will start decay or deterioration or spoilage. So these type of damages are not covered under fire policy. So here what we have to see, the perils which are covered under fire insurance, it is not directly affecting the subject matter, which is stock. There is no contact of peril with the or direct effect of peril with the subject matter. Stock is damaged as a consequence to the damage to the machinery. Machinery is damaged by direct contact with flood or fire, but stocks were not in contact with the peril. Stocks are damaged by decay or deterioration, so it is not payable under fire policy, but it can be covered as an add-on cover. Next is electrical risk, because these have to be covered under MPD policy. This exclusion number 7 in fire policy, commonly known as dynamo clause. Overpressure, overrunning, leakage of electricity, arcing, short circuit due to whatever cause, including lightning, is not covered under fire policy. So here what we have to see, the normally in fire policy, the origin of fire we won't pay. So if a machine is damaged by fire by its own short circuit or overpressure or overrunning or leakage of electricity, then that machine is not payable. Whatever damage due to spread of fire is payable. And there's a wording including lightning, because as you have seen, one of the perils covered under the policy is lightning. But I told you only direct effect of lightning is covered. Lightning as a peril should come in contact with the subject matter, then it is payable. Here this is indirect effect of lightning. Lightning would have struck somewhere in the transmission line or a transformer. It would have caused a surge in voltage, and this surge in voltage would have caused an arcing or leakage of electricity or short circuit within the machine, and the machine would have damaged by the fire source setup. So that machine cannot be covered under fire policy. It is an exclusion. But whatever damages subsequent to that due to spread of fire are payable. Architect, surveyors and consulting engineers fee in excess of 3% of the claim amount. So insured can claim up to 3% of the claim amount as architect fee or surveyors and consulting engineers fee for reinstatement of the property. Similarly, once the properties are damaged then that damaged property is known as debris. It is to be removed so as to reinstate the new property. So that removal of debris uh, requires some expenses. So these expenses are payable up to 1% of the claim amount. These two expenses, architect fee and debris removal, in excess of what is available under the policy, can be covered as an add-on cover. Loss due to war or nuclear risks are excluded. Then pollution and contamination, excluding pollution resulting from an insured peril and peril resulting from pollution. So normally pollution and contamination is excluded under fire policy. However, if this pollution and contamination is caused by an insured peril such as a fire, whenever there is fire there can be smoke, and this smoke can be smoke may damage the walls, painted walls or clean surfaces. So it is known as contamination, or it can cause pollution. So if pollution and contamination are caused by any of the perils, then it is payable under the fire policy. Sometimes there can be a gas leakage and there can be pollution and contamination. Subsequently, it can lead to a fire. So in both cases, where pollution and contamination is followed by a peril or peril followed by a pollution and contamination, in both cases pollution and contamination are payable. If it is a standalone pollution and contamination without any peril acting, then it is not payable. Similarly, loss to bullion, unset precious stones, curios and artworks exceeding 10,000, plans, drawings, checks, coin, paper, money, books of accounts, computer records, goods held in trust unless expressly stated. So this exclusion is having two parts. Up to 10,000 some items are covered like gold bar or silver bar, unset precious stones, curios, artwork, paintings. So these are covered automatically up to 10,000. But certain things like plans, drawings, check, money, books of accounts, computer records or goods held in trust are not covered automatically under the policy. Both these things can be covered with an express statement in the policy. For example, if you want to cover artwork or paintings, it can be stated in the policy and the sum insured can be selected, then it can be covered. Similarly, if you want to cover cash, 1 crore cash, it can be covered, but it should be expressly stated in the policy. If it is not stated in the policy, then it is not covered. So goods held in trust, where the ownership is not there actually, but he acquires the ownership by a contract. Due to that contract, he is having the responsibility for damage to the goods. So he acquires the ownership. That is known as goods held in trust. So that those goods are not covered automatically under the policy. So it is to be expressly stated. Similarly, loss of earnings, market or loss by delay. Whenever there is a peril and damage to the property, for example, in the case of an industry, if there is a fire or flood, then building and plant and machinery is damaged. So further, that production will be stopped. In other words, turnover will come down or turnover may become zero. So naturally, he may not be able to generate profit. So there will be a loss of earnings, and further there can be a loss of market. So these are all termed as consequential losses which are not covered under fire policy. There is another policy known as fire loss of profit insurance where these eventualities can be covered. Next, spoilage due to cessation, retardation, etc. by an insured peril. This I have explained in the first peril, like loss of stocks in cold storage. Similar to that, if stock in process is damaged by itself due to spoilage, let us say a fire peril acted and there is a damage to the machinery, for example a food processing industry. So stock in process moves from machine 1 to machine 2 and machine 2 to machine 3. Let us assume there is a fire damage in machine 3. So then the stock in process cannot move from 2 to 3. So it will be stuck up. So due to delay or due to cessation of work, the stocks within the machine start decaying. So it will deteriorate, but it is not damaged by direct contact with any peril. So it is not payable under the Normal fire policy, of course, it can be covered as an add-on cover under fire policy by an extra premium. Similarly, loss by theft during after loss except as provided in RSMD. This I have already explained. Theft during any peril is not covered under fire policy except in riot and strike, where it is naturally covered. Then loss due to earthquake, volcanic eruption, these are all exclusions. This can be covered as an add-on. Loss to property if removed to other premises except plant and machinery temporarily removed for repairs not exceeding 60 days. So P&M can be removed for repair or some alteration work, but not exceeding 60 days, the cover will continue. So if the plant and machinery is taken outside for repair work to a workshop, cover will continue for 60 days. Other than that, if any property is removed from the location, I told you earlier, fire policy is a location specific policy. So if properties are taken out of the location, the cover will stop automatically. Now coming to conditions in fire policy. There should be no misrepresentation. So you know what is misrepresentation. Insurance will cease 7 days after collapse of the building. If the building is collapsed due to a peril, then after 7 days, naturally the policy will cease unless otherwise it is endorsed or policy is amended by a separate rate and terms and conditions. There should be no alteration in the trade or manufacture in insured premises. So this is known as risk alteration. So this is an important clause in fire policy. Based on the declaration in the proposal form, the insurer assumes the risk and calculate the premium and charge the premium. For example, if a shop owner declares the shop as a provisional store, so we charge the rate assuming that the shop is a provisional store. Now at a later date, during the currency of the policy, if the trade is changed to paint, let us say they are selling paint or crackers, so these are treated as hazardous goods, and this alteration of trade is not informed to the insurance company, then in the event of a claim is not admissible. So these type of alterations which causes change of risk to be informed to the insurance company and terms and rates to be modified accordingly, then only the cover will continue. So it is the duty of the insured to disclose the material fact properly to the insurance company. There is one thing to remember here. In the event of an agreed bank clause with the policy, and if the bank is unaware of the risk alteration, then the claim is payable to bank. For example, in the same case which I have told you, if the bank interest is there, where the actual loanee has changed the shop from provisional store to paint shop, he has not informed the bank also. So bank is unaware of the fact. So bank has not informed the insurance company. Then there is a claim. But then still the claim is admissible because bank is the first insurer in the policy as per agreed bank clause, and bank is unaware of the risk alteration. But if the actual claimant or actual loanee has informed the bank about the risk alteration and bank fails to inform the insurance company, then it is not payable under the policy. There are many disputes over this condition, risk alteration. See, for example, if the proposal form says he is manufacturing, let us say he is manufacturing some goods. So let us say it's plastic goods. So once we get the proposal form, and in the proposal form the client has declared that he is manufacturing plastic goods, then it is our duty to ask the clients what type of plastics you are using as raw material. What is the calorific value of the plastic you are using? So these types of questions we have to ask, and then premium to be charged properly. So as a common man, he has declared I am manufacturing plastic goods. So now it is up to the insurance company to find out what type of risk code to be selected, what type of rate to be charged. For that, whatever questions we have to ask and find out what actually he manufactures, what is the raw material, what is the process involved, and based on that we can select the rate of premium. But if we are not asking any question, if we are accepting the proposal form and if you are putting it under some risk code and later in the event of a claim we find that the risk code is not proper, you cannot reject the claim based on that. Next is if the insured premises unoccupied for a period more than 30 days, then it should be informed to the insurance company, otherwise claim is not admissible. Then if the insurance ceases, if the property passes from the insured to others other than by will or by operation of law. So that means insurable interest changes. If a property is sold, then naturally the new owner is having the insurable interest, but the policy is in the name of the old owner. So then it should be endorsed in the policy or another fresh policy may be taken. There is no transfer endorsement as such in fire policy, but nothing prevents us from passing an endorsement of transfer. So if the ownership changes, you can pass an endorsement in the existing policy and change the ownership to the new client, or you can issue a separate policy also by cancelling the old policy. But if this insurable interest or ownership changes from one party to another party by will or by operation of law, by a court order, then there is no need to inform the insurance company, the cover will continue. If the insured property is covered by a marine policy, then the fire insurance does not operate. So my marine policy should respond first. Insured can terminate the policy on short period terms. Insurer can terminate the policy on pro rata terms with a 15 days notice. So if the insured cancels, then we retain premium on short period basis. If insurer cancels, then retain premium on pro rata basis.
If property is covered by more than one policy, losses will be settled on contribution basis. This is one of the conditions in the policy, except as in declaration clause. So if there is a declaration clause attached with the policy, or if there is a floater declaration clause attached with the policy, then the contribution is not applicable. So there is no contribution between an SFSP policy and declaration policy. There is no contribution between an SFSP policy and floater declaration policy. But if there are two declaration policies, then the contribution will apply. When there are two policies, one is SFSP and another policy is with the declaration clause, then the claim is settled in a different manner. So we will come to that later. Now what is contribution? If there are more than one insurance policy covering the same property against same risk, all the policy will pay rateable proportion. So here the subject matter should be the same. Policies should cover the same perils and against the same risk. There are some court verdicts stating that contribution will apply only when the insured also is the same. For example, there are two insureds, like one insured is keeping goods held in trust. So he is having insurable interest on that. He is taking a policy, and then the original owner, who is the actual owner of the goods, he is also taking a policy. Or one insured is keeping the goods on bailor-bailee relationship. So, and the original owner also takes the policy. So there are some court orders stating that in those cases when insureds are different, contribution will not apply. The original owner has taken a policy, so that policy should respond first. If anything over and above, only the second policy will respond. Anyway, that is not very clear in the associate books and all, but based on the court verdicts, we can come to that conclusion. For example, how this contribution will apply? A property of rupees 10 lakhs is insured with OIC and NIC at 2 lakhs, 5 lakhs and 3 lakhs respectively, sum insured. If there is a loss, all the three companies will pay in 2:5:3. So based on the sum insured, that ratio will apply and each company will pay their due share. This is a working example. Sum insured in policy A is 10,000, policy B is 20,000. So contribution of policy A is 1/3, contribution of policy B is 2/3. Now what will happen in the event of underinsurance? How the average clause will be applied along with contribution. Here sum insured is 30,000, two policies, total 30,000, and value at risk is 40,000. Loss, let us assume it is 16,000. So underinsurance is sum insured by value at risk. So 3/4. So policy A will pay 16,000 the loss amount into 1 by 3 his contribution into 3 by 4 the underinsurance factor. So 4,000 rupees. Policy B pay 16,000 loss amount into policy B's contribution 2 by 3 into 3 by 4 underinsurance. So 8,000. Total payment will be 12,000. So underinsurance reduction is 4,000. So this is how contribution applies when there is underinsurance. Now conditions in fire policy continues. Insured should legally hold erring third parties responsible for the loss so that insurers can enforce subrogation. This is known as subrogation, or other words, if there is a loss to the property and if a third party is responsible, then legally insured can sue the third party. So that legal right is transferred to the insurance company once the claim is paid. So that is known as subrogation. Insured shall make every correspondence with the insurer in writing. Now, there are some more conditions like arbitration, all those things. Now coming to the rating part of fire policy, how a policy is rated. If you go through the tariff, so there are 7 sections. So section 3 deals with simple risk, section 4 industrial risk, section 5 utilities, section 6 storage risk, section 7 tank farms. Now coming to calculation of premium. So to cover a property under fire policy, the entire property is divided into or grouped into different sections. Section 3 for simple risk, section 4 for industrial risk, 5 for utilities, 6 for storage risk, 7 for tank farms. Now how the rating to be done? So first you have to find out the occupancy. If it is a simple risk, as I told you earlier, fire policy from 2001 onwards, as per the tariff, single location, single rate based on the occupancy. So we have to find out what is the risk, what is the occupancy, what is the business performed there. So if it is a simple risk such as a dwelling, places of worships, hospitals, auditoriums, clubs, showrooms, etc., then we can take the rate directly from the tariff. If it is an industrial manufacturing risk, then it is slightly complex. For example, textile mill, engineering workshop, sugar industry, distillery, then we have to refer to section 4. So section 4 is having so many risk codes, somewhere around 208 risk codes are there. So first we have to find out what is the finished products manufactured. So from the proposal form, should be able to determine what is the finished product they are manufacturing. If you are not getting this information, then definitely you may have to ask the questions to the client. So in most of the cases, we can finalize the risk code with finished product. For example, sugar manufacturing, then we have to take the sugar risk code. Agarbatti manufacturing, you can straight away take Agarbatti manufacturing risk code. Or garment manufacturing, so there is a risk code for garment, so it is easy. Now in certain cases, even if we know the finished product, we may not be able to select proper risk code. For example, insured is manufacturing chemicals. So when you go to the tariff, there are 2 risk codes for chemical. Chemical with a flash point less than 32 degrees centigrade, flash point more than 32 degrees centigrade used as the raw material. So in those cases, you have to ask the next question, what is the raw material used? So whether the chemical less than 32 degrees centigrade is used as raw material, flash point less than 32 degree, or whether the chemicals with the flash point more than 32 degrees centigrade is used as the raw material. So once you get the answer, then you can select proper risk codes. In certain cases, we may have to ask further questions like what is the process involved? What type of process is going on? For example, rubber products. So finished goods is rubber, raw material is natural rubber or synthetic rubber. So both finished products and raw material, you are getting answer as rubber. But when you go to the tariff, you can see many risk codes. So again, we have to ask what type of process, whether spreading is involved, spreading is not involved. If spreading is involved, then one rate. Spreading is not involved, then another rate. Similarly, paint manufacturing, whether it is water-based paints, whether it is nitrocellulose-based paints. So Normally from the first question itself, we should be able to find out which risk got to be applied. If not, then we have to ask further questions like what is the raw material, what is the process involved, all those questions should be asked. Coming to the next section, if it is utilities, then utilities especially located outside the compounds of industrial manufacturing risk. What all the utilities within the location is rated as the occupancy. For example, a boiler which is part of sugar manufacturing industry is rated as a sugar manufacturing industry. Whereas the same boiler, if it is situated outside the industrial compound, then there should be some other rate. There should be some other rate. It comes under utility section. Sewage treatment plant, electric substation, pump houses. So these are coming under section 5. Utilities which are within the location to be rated as the occupancy of the location. Utilities outside the location to be rated separately under section 5. So coming to section 6, storage risks. Here also the storage risk we are talking about risks which are storage which are outside the industrial compound. If it is within industrial compound, then the same occupancy. A sugar godown within sugar factory will attract only sugar factory rate. The same sugar godown, if it is outside the factory, then it will attract the rate as per section 6 of the tariff. So then here you have to find out whether what type of category of material is stored inside the godown. So rate for the godown depends on the material stored. What category of material is stored, whether they are storing non-hazardous goods, whether they are storing hazardous goods of category 1, category 2 or category 3. Then accordingly rating to be done. Similarly, whether it is a closed godown or if it is an open storage, there also the rate will vary. Coming to the next section 7, tank farms, gas holders outside. Here also outside the compounds of industrial manufacturing risk such as LPG bullets, gas holders for oxygen, nitrogen, tanks containing liquids, etc. So again you have to see what type of material is stored in tank farms. Then accordingly the rate is to be selected. So final premium rate will be basic rate plus add-on rate. See, add-on rates are either a specific rate or a percentage of the basic rate. So nowadays these rates are all de-tariffed, but anyway for exam purpose. Now coming to add-on covers, I told you there are 12 perils, and then other than 12 perils you can cover certain other perils with the help of additional premium. So when you are covering additional perils or additional expenses with additional premium, they are known as add-on covers. Architect fees, this I have already explained, it can be covered up to 7.5% of the claim amount. Removal of debris, it can be covered up to sum insured up to 10% of the total sum insured. So these are all expenses incurred after the loss. Similarly, stocks in cold storage. If you remember, I had explained why stocks are not payable under normal fire policy. It can be covered as an add-on. There are two add-ons: loss by temperature change due to damage due to machinery damage due to SFSP perils. So if fire or flood is causing damage to the refrigerating machinery, which in turn causing damage to the stock, then stock is not payable under fire policy, but it can be covered as an add-on cover by payment of additional premium. So there is a time excess of 24 hours. So here the damage of stock is happening due to the damage to the machinery which is part of the cold storage. So there is a peril acting within the location causing damage to the machinery, in turn causing damage to the stock. This is actually in the tariff is known as DOS B. Now there is another cover known as DOS A. The same stock damage by change in temperature, but here it is due to failure of electric supply due to SFSP perils. So here the peril is acting outside the location and the supply, electric supply to the premises is cut off due to any peril or for safety reasons if it is cut off by the authority. So there is no electricity, stocks inside the cold storage is damaged by rise in temperature, so it is admissible. So this is a high risk cover because our insured is not having any control over the damage or property outside his premises. It totally depending on the power distribution company or power generation company. So it is a high risk cover. Normally we should not give. Again there is a time excess of 24 hours. Next is forest fire. You may be remembering bushfire was covered under, bushfire is covered under fire policy, but here it is an additional cover. I told you what is the difference between bushfire and forest fire. So it specified sum insured to be declared. Another cover is impact damage by vehicles of insured. So this was an exclusion under standard policy. So impact damage is covered. Impact damage by insured's own vehicle or forklift or other material handling vehicles. So it is an exclusion under standard policy, but you can cover it as an add-on. Next is spontaneous combustion. Spontaneous combustion is one of the exclusions under standard fire policy under fire, but here it is an add-on cover. You can cover it. There are 4 categories. The materials are segregated into 4 categories in tariff. So as you move from category 1 to category 4, it goes like low risk to high risk. So that means category 1 is having the lowest rate, category 4 is having the highest rate. If you remember the EQ rate, the reverse. Zone 1 carries highest rate, zone 4 carries lowest rate. So here it is category 1 is having lowest rate, category 4 is having highest rate. So sum insured for the commodity is specified. Next is omission to insure addition, alteration or extension. It can be covered up to 5% of building and plant and machinery and accessories sum insured. So in the event of omission to cover any building or any machinery or addition during the policy period or alterations or extensions, it is covered up to 5% of the sum insured. Now next is earthquake, that is also an add-on cover. Next is spoilage material damage cover, stock and machinery. So this I explained while explaining the exclusions. Let us say stock in process is moving from machine 1 to machine 2. Machine 2 is damaged by insured peril. There is no damage to machine 1. However, stock cannot move to machinery 2. So due to the time delay, the stock will be damaged or deteriorate. So this damage is not covered under fire policy because there is no peril acting on the particular subject matter. It was acting on another surrounding or nearby property, but stock cannot move to the next stage. So it is damaged. So this can be covered as an add-on cover. In the event of such a damage, it can cause damage to stock. It can cause damage to that machinery where that stock is lying. So both can be covered as an add-on cover. Spoilage of stock and spoilage of machinery. So value of stock or machinery in specified block to be covered. So leakage and contamination. This is an add-on cover. We have to specify the sum insured. If there is a damage due to leakage or contamination due to any chemicals, then it is payable under the policy. Next is temporary removal of stocks. Here the sum insured is policy sum insured. However, maximum 10% of the stocks that can be removed or outside location at any point of time. So 10% of the policy rate is applied to find out the premium. See, for this clause, there is an average clause applicable, like whatever loss or damage value into temporary removal sum insured, that is 10% of the policy sum insured, divided by actual value of stock temporarily removed. So whatever value of stock outside the location, and as per policy it is only 10% allowed. So in that ratio, under insurance will be applicable. This is apart from the normal under insurance applicable under the policy. Now next is loss of rent cover. Here also we have to specify the sum insured and then the period for how many months. For example, sum insured is selected as 12,000 rupees and period selected, indemnity period is selected as 12 months. So after the loss, after the damage to the building, suppose the owner of the building is losing rent till the reinstatement of the building. Let us assume building is damaged and it is taking 6 months for reinstatement. So during that period he is losing the rent if it is a rented building. So that can be covered as an add-on cover. So let us assume 12,000 is the sum insured selected and 12 months is the indemnity period selected. So in the event of a claim, there is an economic limit applicable. So 12 months and 12,000 rupees means 1,000 rupees per month. So he can claim only up to 1,000 rupees. Let us say reinstatement period is 8 months. Then he will get a maximum of only 8 into 1,000, 8,000. So that is the economic limit. Next is insurance of additional expenses of rent for an alternate accommodation. So this cover actually applicable for both owner of the building and tenant of the building. It can be given for only non-manufacturing units. Maximum indemnity period is 36 months, 3 years. Only for Pakka buildings. Alternate accommodation can be within the city or municipality limits. It can be issued to owner, occupant or tenant. So if owner is occupied his building and there is a damage and it requires some time for reinstatement, for time being he is taking another building for rent, so that rent is payable subject to the limit. In the case of a tenant, he is as a tenant inside a building and he is paying certain amount of rent. Now after the damage he cannot occupy that building, so he has to alternatively he has to arrange another building. So let us assume for the original building he was paying 10,000 rupees per month as rent. Now after the damage he is finding out another building but the rent is 12,000 per month. So this additional rent 2,000 rupees is payable for the tenant. For the owner occupant, whatever amount he is incurring as rent for the new building minus the normal rent calculated by the municipality, that will be deducted. That will come in the next slide. Anyway, under insurance are all applicable in this case also. Rent claimed, whatever rent he is claiming into sum insured divided by monthly additional rent for alternate accommodation into indemnity period in the policy. So the insured has to select sum insured has to select the indemnity period. Based on that, once he makes a claim, under insurance will be applicable in the ratio rent claimed into sum insured divided by monthly additional rent for alternate accommodation into indemnity period in the policy. For example, he has taken 12,000 rupees as sum insured and 12 months indemnity period. Let us say he is claiming additional rent. So naturally he can claim only 1,000 rupees as additional rent. Let us say he is claiming 2,000 rupees as additional rent. So it will be limited in this ratio. So if it is issued to the tenant, then amount of additional rent payable is equal to rent for new accommodation. If he is still paying the rent for the already damaged building. So there are two cases for the tenant. Suppose he is occupying a building and the building is damaged. Let us say he is paying 10,000 rupees rent, and then after damage he is occupying another building where he is paying 12,000 rupees as the rent. There can be two cases. First case is that after damage he need not pay any rent because the building is damaged. So he has to pay only the new rent. So what insurance company is liable for? Only additional rent, because even otherwise he was incurring 10,000. Now he is incurring 12,000. So the additional 2,000 rupees insurance company will pay. But in certain cases, though the building is damaged, still tenant is liable to pay the rent because he may be responsible for the damage. He has to pay the rent for the original building 10,000. He has to pay the rent for the newly occupied building, that is 12,000. So in that case, he can claim the 12,000 rupees rent as a whole because that is additional amount he is incurring due to the loss. But when owner occupant is the insured, then amount of additional rent payable is equal to rent for new accommodation minus standard rent. So standard rent for the on premises fixed by the municipal or revenue authority. So there is a reduction from the owner occupant rent also. The next cover is startup expenses cover. This cover is applicable only for certain type of industries where they have to incur some additional expenditure to resume operations after the damage. We may have to incur certain expenses for certain catalyst, certain chemicals to restart the operation. So that additional expenses are payable under the head startup expenses. So one more cover was introduced by Tariff Advisory Committee, that is known as molten material spillage. So this is normally applicable in foundries where the molten material is transferred from the furnace to the mold. So at that time, if spillage occurs, then not only that material loss due to the high temperature, wherever it is falling, all those property will burn. So molten material spillage also can be covered as an add-on cover. So we have seen what is a fire policy, what are all the perils covered, what are all the exclusions and conditions in the policy. and how the ratings are done, the different sections of the tariff, and how to select the occupancy. Now coming to the variations, different types of fire policies: fire declaration policy, fire floater policy, then floater declaration policy. So within SFSP, we can issue policies with certain additional clauses. Let us see fire declaration policy. So normally these policies issued to take care of frequent fluctuation in stock. If the insured is keeping stock and the stock is fluctuates every month based on the season, so in that case he can opt for this declaration policy. Minimum sum insured is 1 crore in one or more locations. So policy can be issued for one location or it can be a multi-location policy. Minimum sum insured is 25 lakhs in at least one location. Minimum policy sum insured is 1 crore. Minimum sum insured per location is 25 lakhs. Then monthly declarations to be submitted to the insurance company. It can be based on average of the values at risk on each day of the month or highest values at risk during the month. So insured should opt for declaration policy if there is a fluctuation in his stock and the minimum stock value is 1 crore. So he should select the sum insured in such a manner that at any point of time the value at risk should not exceed the sum insured. After selecting the higher sum insured, he can declare actual value of stock he is keeping every month. So if the value of stock he is keeping every month is less than the actual value he has taken as sum insured, then he is eligible for a refund. So how the declaration is to be done? On a monthly basis. So each declaration should reach the insurance company before the last date of next month. Now there are two methods of declaration. One is average of the values at risk on each day of the month. For example, January month declaration he wants to give. So he should record the stock value on each day of January from 1st of January to 31st of January and then average it. Find the sum, then divided by 31. So that will give you the average of the values on each day of the month. So each day of the month he should record the stock value and he should find the average, and that average can be declared to the insurance company. Second option is that higher value at risk during the month. So he can declare after monitoring the stock position on each day of January from 1st January to 31st January, he can find out which was the highest value on a particular day. So that value can be declared and for January month. So these are the two methods available. Next condition is that reduction in sum insured is not allowed. And whatever declarations, insurance company will add all those declarations for each month, 12 declarations, find out the average and apply the policy rate, find out the premium payable, and then calculate the refund. So whatever premium he has already paid minus premium payable will give you the refund, and refund should not exceed 50% of the total premium. So he can always select a higher sum insured, and he can give a declaration every month promptly, and he can opt for this refund. And basis of value of declaration shall be the market value. Of course, here we are covering only stock, so the basis of valuation should be market value. And declaration policy, there are some restrictions. It cannot be issued for a short period. It cannot be issued for stock in process. It cannot be issued for stock at railway sidings. Since the facility of declaration and refund is there, this restriction is applied. It cannot be given for a short period. So it should be taken for 1 year. And stock in process, as you know, any industry, the value of stock in process will not fluctuate. As long as the capacity, production capacity remains the same, the stock in process, the quantum also remains the same. So declaration facility is not required for stock in process at all. I told you earlier, declaration facility is required wherever there is a fluctuation in stock. So stock in process does not fluctuate. So declaration facility is not required, it is not given also. Stock at railway sidings, the computation of value of stock at any point of time will be a difficult task, and stock at railway sidings also insured, the control of insured is very limited. So this may be the reasons why declaration facility is not extended to railway sidings. So the rules of declaration. If there is no stock, then nil declaration is to be made. So if the insured finds that on a particular month there was zero stock, still he has to give a zero declaration. If declaration is not made for a month, sum insured will be deemed as declared. So if he omits to give declaration, if he is not giving any declaration to the company, then we take it as the sum insured as declared value. The declaration for a month shall reach latest by last day of next month to the insurer. This I have already explained. All told declarations are added and find average value. Premium is recalculated on average value and refund is allowed subject to a maximum of 50%. So here the refund is limited to a maximum of 50%. So while choosing the sum insured should keep these things in mind. Reinstatement premium collected towards any claim settled should not be considered for declaration refund. So whatever reinstatement premium you have collected for the amount of claim you have settled, again that premium should not be taken for refund because you have already taken the actual premium collected towards that property for refund. So twice need not be considered. Average clause is applied twice in declaration policy. This is an important condition. 2 times under insurance is applied. Under insurance 1 is amount claimed into last declared amount by amount that ought to have been declared. So for example, month of March, insured has given a declaration of 1 crore and there is a claim in April. So surveyor finds that during the month of March, actual value of stock was 1.2 crore. So insured declared it deliberately a less value of 1 crore. So he should be penalized for that. So loss amount into last declared amount, that is 1 crore divided by 1.2 crore, amount that ought to have been declared. So here whenever we are setting a claim on declaration policies, it is the duty of the surveyor to check the declarations he has submitted till the date of loss. Whatever be the last declaration he has submitted, it will be compared with his actual stock value. Then if actual stock value for that particular month is more, then under insurance is applied. This is under insurance 1. Under insurance 2 is the usual average clause in the policy, amount claimed into sum insured by value at risk. For example, he has taken a sum insured of 1 crore and value at risk as on date of loss is 1.5 crore, then of course the under insurance is applicable. Let us see an important rule in declaration policy. If at the time of loss the property is covered under any other insurance other than on declaration basis, then that policy will operate first and pay the claim. Declaration policy will pay only excess of the value of stock over the sum insured under the other policy. The insurer shall be liable under declaration policy to pay only a proportion of such loss which such excess but not exceeding the sum insured thereby bears to the total value of the stocks. If 2 declaration policies are there, a rateable proportion of such excess. See here you have to remember 1 or 2 things. If the same property is covered under 2 declaration policies, then as usual contribution will apply. But if the property is covered under a normal SFSP policy and a declaration policy, then the contribution normally does not apply. If SFSP policy is sufficient, that means sum insured is sufficient to cover the value at risk, then SFSP policy will pay in full. But if SFSP policy sum insured is not sufficient, then what is lacking? What is the excess over SFSP policy compared to the value at risk? To that extent, declaration policy will pay. Here also, in that instance, if there is only one SFSP policy and there are 2 declaration policies, so whatever declaration policies liability will be shared within 2 declaration policies. So contribution is applicable between the declaration policy. Pure contribution is not applicable between SFSP and declaration policy. See, let us take an example. Here SFSP sum insured is 1 lakh and declaration policy sum insured is 2 lakhs. Total sum insured is 1 plus 2, 3 lakhs. Whereas value at risk is 4 lakhs and loss, let us say there is a loss of 3 lakh. So first of all, here there are two policies. One is SFSP, other one is declaration policy. So pure contribution normally will not apply. Let us assume first SFSP sum insured is 5 lakhs. So what would have happened? Value at risk is 4 lakhs. So SFSP sum insured is adequate to cover the stock. Loss is 3 lakh. SFSP policy would have responded and paid the loss of 3 lakh in full. Declaration policy will be silent. The insurer who has issued the declaration policy need not settle any amount. First, SFSP policy will respond. So this is the first scenario. Now coming to the second scenario, here SFSP policy sum insured is only 1 lakh, whereas the value at risk is 4 lakh. So difference over the word is used in that paragraph as excess. Excess of the value over the value at risk is 4 lakh minus 1 lakh. So 3 lakh is left out. Out of that 3 lakh, declaration policy is issued for 2 lakh. So again there is an underinsurance. So what will happen? Let us see how much SFSP contributes. Amount payable under SFSP policy after underinsurance is equal to the loss, that is 3 lakh, into 1 lakh, that is the sum insured under SFSP policy, divided by the value at risk, 4 lakh. So SFSP policy will pay 0.75 lakh because of underinsurance. Now how the declaration policy will operate? Declaration policy should operate to the extent of excess over the SFSP sum insured. Here excess over the SFSP sum insured is 4 lakh minus 1 lakh. Here the excess means the difference between sum insured under SFSP policy and value at risk. So here it is 4 lakh minus 1 lakh. So declaration policy naturally should contribute up to that 3 lakh, that is the difference. But it is subject to a limit of sum insured in the declaration policy. That is why the wording declaration policy will pay only excess of the value of stock over the sum insured under the other policy, but not exceeding the sum insured thereby. So let us see how declaration policy operates. Amount payable under declaration policy is equal to 3 lakh, that is loss, into, here it should be sum insured, by sum to be insured, normal course, but here it is, we have to see what is the difference or excess between SFSP and value at risk. It is 3 lakh, so it is more than the sum insured under the declaration policy. So we are restricting to the sum insured under the declaration policy, that is 2 lakhs divided by 4 lakhs, that is a value at risk. So here we will pay under declaration policy 1.5 lakhs. So total payment will be 2.25 lakhs, which is still below the actual loss suffered by the insured. This difference is due to the underinsurance, huge underinsurance. Sum insured is only 3 lakhs for both the policies put together, but value at risk is 4 lakhs, so he has to bear a portion of the loss. So here you have to remember that excess, that means the value at risk minus sum insured under SFSP policy, 4 lakh minus 1 lakh, that is 3 lakh. It is exceeding the sum insured under the declaration policy, hence sum insured is taken for the contribution calculation. So here loss is not settled in full because value at risk is more than the total sum insured. Another scenario where the SFSP policy is having the same sum insured of 1 lakh, declaration policy is having a sum insured of 2 lakh, total becomes 3 lakh. Now value at risk is only 2.5 lakhs. So that means both policies put together, it should be sufficient to cover the entire stock holdings of insured. Now let us say loss of 1 lakh. So SFSP contribution will be loss into sum insured divided by sum to be insured. 1 lakh into 1 lakh by 2.5 lakhs equal to 0.4 lakh. Now declaration policy contribution. So if it is a normal contribution law, then it is loss into sum insured by sum to be insured. So 2 lakhs into 1 lakh into 2 lakh by 2.5 lakh. But here if you see the excess part, the excess over the SFSP policy, that is 2.5 minus 1 is 1.5, which is less than the sum insured. So that declaration policy will respond only to up to that limit of excess, subject to a maximum sum insured. Here excess is only 1.5 lakh. So declaration policy will contribute only for that excess portion. So amount payable and after underinsurance is loss into 1.5 lakhs, that is the excess of SFSP policy sum insured compared to the value at risk. divided by 2.5 lakhs. This will give you 0.6 lakhs. So 0.6 plus 0.4, insured is getting 1 lakh. He is getting the full loss amount because value at risk is less than the total sum insured. Here the excess of value of stock over SFSP is 1.5 lakh, which is less than the sum insured under declaration policy. Hence, excess is taken for claim calculation. If in the same example, if there are two declaration policies having 1 lakh each, then in that case, that contribution will be 50% will go to first declaration policy, 50% will go to the second declaration policy. So first declaration policy will pay 0.3 lakh, second declaration policy will pay 0.3 lakh. This is how contribution applies in declaration policy. So while explaining the contribution, I told it is not the pure contribution like two SFSP policies. There is some difference. This is how it operates. Fire floater policy. When stocks are stored in different locations and it is to be covered under a single sum insured, then fire floater policy is issued. So floater policy will have single sum insured but different locations will be covered. So rate to be charged is the highest rate applicable for any of the locations into 10% loading. Presence of kacha construction may be ignored. If process blocks are also covered under a floater policy and if process rate is more than the storage rate, then process rate plus 10% is applicable. So the rule is highest rate plus 10%. If floater policy is issued to cover stocks in different godowns and process blocks within a premises, floater extra is not applicable. So this scenario nowadays it is very rare. Nobody will issue a floater policy for a single location. But if at all it is issued to cover different godowns within the location, then floater extra is not applicable. Floater declaration policy is a combination of both floater and declaration policies. So both the conditions of declaration and floater are applicable here. Minimum sum insured is 2 crore. Maximum refund allowed is 80%. That means after getting all the declarations from the insured, average value is calculated, then premium to be chargeable is calculated, then refund is allowed. So minimum retention is 80%. Maximum refund allowed is 20%. Now let us see the clauses in fire policy, like agreed bank clause. So as I explained earlier, if bank clause is there, risk alteration clause in fire policy, that is condition number 3, will be modified. So if bank's interest is there and the insured, actual insured alters the risk without informing the bank and bank is unaware of the alteration, then this clause risk alteration condition will not have any effect. Insurance company will have to pay the claim to the bank. But if bank is aware of the alteration of risk and still he has not informed the insurance company, then risk alteration condition will apply and the claim will not be payable. Next is contract price insurance clause. This clause is attached to policy covering imported goods applicable for goods sold but not delivered, for which the insured is responsible. If the sale contract is cancelled wholly or partially, then the liability of the company shall be contract price and not the market value. So normally finished goods are covered based on market value. So if finished goods are damaged, insurance company will pay the actual manufacturing cost of the goods. It can be arrived at by two methods. One, raw material cost plus all process cost till the stage of production. Second method is that we have to take the sales invoice of the finished goods minus gross profit. So either way, insurance company will pay only the market value or rather actual manufacturing cost of the finished goods. So profit element is not paid. But here that condition is getting modified by contract price insurance clause. So strict indemnity principle is modified by contract price insurance clause, whereby insurance company is liable for the profit element. So here in this case the contract of sale is confirmed. So the finished goods are ready for dispatch. At that time there is a loss. So insured is actually losing not only the manufacturing cost but also the profit expected from the finished goods. So if this clause is attached and if goods are damaged and if contract price insurance clause is there and invoicing already happened, that means the sale contract is over, closed, then insurance company will pay including profit. Another clause is designation of property clause. Here insurer agrees to accept the designation of property as per the insured's books of accounts. So there can be some confusion or disputes in the event of a claim, whether it is a plant and machinery or it is a stock or it is a furniture and fixture for a particular property. So in such cases, when there is a dispute, if this clause is attached, then insurance company promises that we will go by insured books of accounts. For example, a policy covering stock. Oil is stored as a stock for replenishing the same in machine. In the event of a claim, the dispute will be to treat oil as part of machine or as stock. So if designated property clause is attached and if the insured's books of account shows oil as stock, then the insurer shall treat the same as stock and the claim shall be settled in the stock policy. So for stock of oil, if insured has taken a policy for stock and his books of account states that oil is termed as stock or accounted as stock, then definitely if there is a damage to oil, insurance company is liable to pay under the stock policy. So there can be interpretation that this oil is part of the machine, so it should be part of plant and machinery only. So similar types of disputes we can depend on designation of property clause. It's a free clause. Escalation clause applicable for building, plant and machinery and accessories and furniture and fixtures, not for stocks. If escalation clause is attached and a percentage is selected, then automatic increase in sum insured on daily basis to the extent of 1/365th of specified percentage, and maximum escalation allowed is 25%. For example, policy is issued with a sum insured of 10 lakh. Escalation is 20%. If there is a loss on 100 day, then value at risk will be computed by adding this escalation amount to the basic sum insured. So sum insured plus sum insured into 20% into 100 by 365. That means escalation of 20% is applicable only on the last day of the policy. So each day there is a proportional increase in escalation. So 100 by 365 is the proportional to be applied on 20%, and then average clause will be applied if necessary. So to apply the average clause, value at risk is compared not only with the sum insured but sum insured plus escalation. There is another clause known as local authority clause. RIV policies may be extended with this clause. That means local authorities clauses are applicable only when the policy is issued on RIV. It covers additional cost of reinstatement incurred by the insured to comply with the regulation enforced by the authority. So if after the loss to reinstate the property, if the insured has to incur some additional expenses due to the new regulations enforced, then insurance company has to pay the additional amount. For example, a house, residential building is damaged totally and the insured wants to reconstruct. For reconstruction, there is a new regulation that there should be water harvesting system. So the cost of water harvesting system to be paid extra. Now the amount recoverable shall not include, this is an exclusion, the cost incurred in complying with the regulations in respect of destruction damage occurring prior to granting of the extension. So if the damage is happened before issuance of the policy or before addition of this clause, then those expenses insurance company is not liable. In respect of destruction or damage not insured by the policy, if part of the property is not covered, to that extent this expenses incurred to comply with the regulation is also not applicable, under which notice has been served upon the insured prior to the happening of destruction of damage. So suppose the insured has already received a notice for making water harvesting system on or before such date, and so he was about to make it, whether this loss was there or not, he has to spend that expenses. So in that case, insurance company is not liable. In respect of undamaged property or undamaged portions of property other than foundations. So if only part of the property is damaged, then whatever expenses incurred will be proportionately reduced. Expenses in the sense additional expenses to comply with the regulations will be proportionately reduced. Additional cost that would have been required to make good the property damaged or destroyed to a condition equal to its condition when new and new had the necessity to comply with any of the aforesaid regulations of bylaws not arisen. The amount of any rate, tax, duty, development or other charge or assessment arising out of capital appreciation which may be payable in respect of the property or by the owner thereof by reason of compliance with any of the aforesaid regulations or bylaws. So these expenses are not payable. So other than this compliance of regulation, if there is any additional cost that would have been required to make good the property, those additional costs are not payable. And because of capital appreciation, any additional rate, tax or duty or development charges are payable, that also will not come under this local authorities clause. Again, the work of reinstatement must be carried out within the 12 months of destruction or damage or such further time as insurance company may allow, and it can be on the same site or in another site subject to the condition that liability of the insurer under this extension not being increased. So the reinstatement should be carried out within the 12 months, or if any other extension is allowed by the insurer within that extension period, it can be carried out on this site partially or wholly or in another site, but liability of the insurer should not exceed. If the liability of the insurer under any item of the policy apart from this extension shall be reduced by the application of any of the terms and conditions of the policy, then the liability of the insurers under this extension in respect of any such item shall be reduced in like proportion. For example, insurance is policy is already subject to under insurance of 50%. Then whatever expense is additionally incurring to comply with the local authority clause, that also will be reduced in the proportion of 50%. So whatever condition applicable to the main policy is applicable to local authority clause also. The total amount recoverable under any item of the policy shall not exceed the sum insured. So it should not exceed the sum insured. All the conditions of the policy except in so far as they may be hereby expressly varied shall apply as if they had been incorporated therein. So all the other terms and conditions of the policy is applicable. No additional premium is charged. All India Fire Tariff is having 8 sections. First section talks about general rules and regulations. Second section is the policy wording. From section 3 to section 7 is the rating, symbol risk, section 3, industrial risk, section 4, utilities, section 5, storage risk, section 6, tank farms, section 7, and add-on covers are described in section 8. This is just for understanding how AIFT is designed. Originating risk refers to causes of fire such as electrical, lightning, smoking, friction, overheated materials, hot surfaces, molten material, cutting, welding, burner flames, sparks, static sparks, spontaneous combustion, chemical action or malicious act. So these are the areas or causes starting a fire damage. So fire starts or ignition starts from these type of hazards: electrical hazard, lightning hazard, smoking, friction, like this. So that is why it is known as originating risk. Now there are certain other types of hazards known as contributory risk, circumstances which increases the probability of fire occurring, which enables the fire to spread and increases the loss. So these are known as contributory risk. For example, construction such as woodwork, presence of waste or hazardous material, absence of people to raise the alarm, locked or inaccessible premises or isolated premises, exposure to other buildings in hazardous occupation. So here fire already happened, but then it contributes to the spread of fire. For example, why we treat silent risk as more hazardous compared to a running factory? Because in silent, when the risk is silent, when there is no manufacturing activity, there won't be any people to safeguard. So if a fire starts, then it will destroy the entire property. That is why silent risk is actually more riskier than the normal risk. Similarly, if the production area is filled with woodwork or wastage of material, if housekeeping is bad, all these things will contribute for spread of fire. Next type of fire hazard is risk from construction. So the type of construction of wall, type of construction of RCC, it all contributes to the risks of fire. For example, if the wall type is RCC or brickwork or corrugated iron sheet asbestos, cement sheeting, glass or timber. So that risk increases in that order, whatever it is given. So if the wall is of glass or timber, then risk of fire is more. Similarly, the roof type, if it is timber or thatched roof, then the risk of fire hazard is high. Now coming to height of the building. Shed structure is always better than a multi-storied building. So you would have seen industries constructed on a vertical plane, like so many stories on a single building. So such buildings are considered to be more hazardous compared to the shed structure. Shed structure means in within the location more area is occupied with different buildings. So height of the building will be less, maybe 1 floor or 2 floor, but it will be spread to a certain area. So in that case, spread of risk is achieved. So even if there is a fire in one of the sheds or building, it may not spread to the other building. Whereas in a vertical building, the first thing is that if there is a fire, then firefighting is extremely difficult at the top floors. See, normally when hydrant systems are used for firefighting at a particular height, so normally the water pressure drops 0.1 kg per centimeter square per meter. So if the height is more, then the water will not have that pressure to extinguish the fire. And other thing is that if there is a firefighting going on the third floor, naturally the water will flow down and it will damage the second floor and first floor plant and machinery and stock. So whether it is a fire damage or then water damage, ultimately it is a damage to the property. Similarly, if one floor is weakened by fire, then it may collapse to the other floor and the entire building may collapse. And similarly, the fire can spread through the existing windows or floor openings. So these are all the drawbacks of multiple storage building. So if entire assets are occupied and entire assets are kept in one building and entire operations are carried out in one building compared to different buildings like a shed structure, then the risk is more in the first one. Similarly, size of the building. Greater the size, greater the fire hazard. Internal construction such as floor opening, false ceiling, internal partition, this all contributes for fire spread. See, for example, if a godown is constructed as a very big godown, single godown from one point to maybe next point, maybe 100 meter or 50 meter, huge godowns. So in that case, it is considered as very high risk. Normally, the probable maximum loss assessment will be done at 100%. So any fire or flood happens, it can spread to the entire area. Here we are talking about only fire, but still, if the fire starts from one end of the building, if hazardous materials are there, the entire building will be damaged. Whereas the same stock or same property, if it is kept in different blocks, then spread of fire is difficult. The damage will be reduced. So if it is a single godown without any partition, it is considered as a single block and the risk is very high. Now let us see some of the fire extinguishing appliances. So before going to the appliances, please understand that there are two types of firefighting system. One is active system, other one is passive system. Active system means it requires some form of action, either manually or automatically. And normally it comes into effect only once the fire is started. So once fire is started, maybe the heat is sensed by a bulb of the sprinkler and sprinkler breaks and water sprayed into that area. That is an active firefighting system. Similarly, usage of hydrant, smoke detectors. So whatever detection elements or sensing elements, and again the whatever equipments you are using to extinguish the fire or douse the fire, contain the fire, these are all active systems. And another system known as passive system, where we anticipate a fire spread, so we keep compartments within the plant. So compartmentalization happens, which prevents the spread of fire. There will be fireproof walls, fireproof doors. So the single building or single block is separated into different compartments, so that even if there is a fire starts in one of the compartments, it will not spread to the other. So anticipating the fire, the systems are already built in. This is both for human safety as well as property safety. So these type of systems are known as passive systems. So passive systems already built in anticipating a fire, whereas active systems will come into action only when fire starts. So passive systems actually it will reduce the spread of fire. Now coming to appliances, you would have seen fire extinguishing appliances, portable extinguishers, like portable extinguishers are there, buckets, internal hose reels, these are all known as first aid appliances. Then external appliances such as fire engine, trailer pumps, hydrant systems, sprinkler installations, special extinguishment systems. Then automatic, medium and high velocity water spray system. So these are all different types of systems used for extinguishing the fire. See, normally carbon dioxide extinguishers are used where electrical fire, in the case of electrical equipment fire or flammable liquids. Dry chemical extinguishers are used where flammable and also electrical fire. Foam systems are used where flammable liquids of oil and gasoline types. If there is a fire to the oil, then there is a chance that oil cans can break and fire can spread through the oil. So in these type of fire, foam systems are the best. Mutual aid scheme means if there is an agreement between different neighboring companies, if there is a fire loss or fire damage in one of the companies, then other companies will also come into the rescue. That is known as mutual aid scheme. It is an agreement among the companies. Now let us see what is party wall. Two types of party walls are there: perfect party wall and party wall. I talked about compartmentalization of a single block. So it is achieved by party wall. So perfect party wall means the party wall will extend beyond the roof level, maybe 2 feet height. So in the event of even the collapse of roof, it will not spread to the other area. So it will perfectly resist the fire. Whereas a party wall, normal party wall will be up to only roof level. So if there is a collapse of roof, then every chance that it will spread to the other area. But it will contain the fire till the roof collapses. So perfect party wall is always better than a normal party wall. Now coming to the classification of goods in storage. While talking about the storage risk, I have explained that the premium rate of storage risk depends on the type of material stored inside. So those materials which are stored in a storage area is classified into different groups such as non-hazardous, hazardous of category 1, category 2 hazardous, category 3 hazardous, then coir waste, coir fiber and caddies. Now let us understand how this classification is done. How materials are classified into category 1, category 2 and category 3. See, category 1 is less hazardous compared to category 2. Category 2 is less hazardous compared to category 3. So category 3 is the highest hazard. And the coir waste and caddies are treated as more hazardous than even category 3. Now let us see what are all the materials coming under category 1 and how it differentiate from category 2 or category 3. Category 1, solids which are moderately or slightly combustible. So there is another category. In the previous slide you have seen non-hazardous material. So those materials are not combustible at all. But here category 1 is solids which are moderately or slightly combustible, like cotton or sugar. Similarly, flammable liquids having flash point above 65 degrees centigrade. So liquids with flash point above 65 degrees centigrade. Flash point means when the temperature reaches to that 65 degrees centigrade or whatever temperature, it will ignite by itself, auto ignition. So if the liquids are having a flash point above 65 degrees centigrade, then it is treated as category 1. Inert gases, non-combustible gases are treated as category 1. Highly toxic materials also treated as category 1. Waste of non-hazardous materials. So whatever waste coming out from the non-hazardous material, it is treated as category 1. Now coming to category 2, pyrotechnic materials. Pyrotechnic materials means materials once a spark is given, a fire origin is there, then it will spread suddenly or violently like a cracker and it will produce huge amount of heat and flame. So it's highly hazardous material. So once there is a spark, it will spread very rapidly. So These are all pyrotechnic materials. Coming to liquids, liquids having flash point below 65 but above 32. So here the slab is different. Category 1 is up to or flash point above 65. Here category 2 32 to 65. Flammable liquids, paint, varnish having flash point below 32 degree but stored in sealed tins or jars or drums. So flammable liquids with the flash point below 32 degree, if it is in sealed tins or jars or drums, then it is treated as category 2. Otherwise it is treated as category 3. So liquids, paints, varnish where the flash point is below 32 degrees treated as category 3, whereas if it is in tins or jars or drums it is treated as category 2. And then moderate oxidizing agents, chemicals, materials which evolve combustible gases in contact with water. Waste of category 1 hazardous material. So waste of non-hazardous is treated as category 1. Waste of category 1 material is treated as category 2. Waste of category 2 and 3 are treated as category 3 material. Now coming to category 3, materials which are self-ignitable or explosives. So these are all self-ignitable or explosives. Then flammable liquids where flash point is less than 32. Then strong oxidizing agents like chlorine. So sodium hypochlorite. So these are all strong oxidizing agents to be treated as category 3. Then combustible gases. Then waste of category 2 and 3 hazardous materials. So once you get an idea of the item stored, then you should determine whether it is a non-hazardous, category 1, category 2 or category 3. And these are the certain properties or conditions by which you can bifurcate the material. Otherwise the tariff itself shows a list of category 1, 2 and 3 material practically. You can find out the material belongs to which category. And normally the rates for category 1 and category 2 and category 3 and non-hazardous are different. Naturally, if materials are stored belongs to category 3, then the rate will be higher compared to category 2 and category 1. But presence of hazardous materials of higher category is allowed up to 5%. For example, if the material stored in the godown is category 1, then 5% of the materials can be category 2 or category 3. Now let us talk about warranties. See, policy is a promise given by the insurer to the insured in the event of a calamity, uncertainty, in the event of an event causing damage to the subject matter. Insurance company will pay or indemnify the insured in the event of a damage. That is a promise. Whereas warranty is the promise given by the insured to the insurer. See, and these warranties are inserted for a specific purpose. For example, FEA warranty, class of construction warranty. So FEA warranty means the insured promises to the insurer that he will keep some fire extinguishing devices. Certain types of fire extinguishing devices he will keep in the industry to safeguard the industry. And another thing, class of construction. He promises that his industry will have a class 1 construction. It can withstand heat up to 4 hours. It can withstand fire up to 4 hours. That is class 1 construction. So this is the promise given by the insured to the insurer. And if the promise is violated, then it is up to the insurance company to take a decision whether to accept the claim or reject the claim. So once warranty is breached, then insurance company can accept or reject the claim based on the situation. Normally, if the warranty breach is material to the loss, insurance company rejects the claim. If the warranty breach is not material to the loss, then insurance company accepts the claim. But this is not a hard and fast rule. Each insurer can take his own decision. For example, there was one FEA warranty in the policy. Insured promises that he is having certain type of extinguishing devices in the factory, but it was not there. Nothing was there to fight the fire, but property damaged by flood. Now there is a warranty breach, but it is not material to the loss. So normally insurance companies will take a relaxed view and pay the claim. Now how it is applicable in our while categorizing the risk in different occupancies. If shop is rated as non-hazardous, then it is warranted that storage of hazardous material not to exceed 5% of the total stock. So if you see the tariff, you can see shops are categorized into two: normal shops and shops having hazardous material, or shops selling hazardous material. So if the risk is rated under normal shop, then there is a warranty that storage of hazardous material is not exceeding 5% of the total stock. Similarly, when stock stored in godown are category 1 hazardous nature, then a warranty is inserted as goods of category 2 and 3 and coir waste, coir fiber and caddies are not stored thereon or therein. If you see some types of risk, for example, paint manufacturing industry, you can see three types of risk codes: water-based paints, other than water-based paints, nitrocellulose-based paints. And you see nitrocellulose-based paints attracts more rate because it is more risky. So when the policy is or occupancy is taken as water-based paints, then there is a warranty inserted in the policy that other than water-based and nitrocellulose-based paints are not manufactured therein. So we have charged a premium for only water-based paints. So insured should give a promise that he will not manufacture any nitrocellulose based paints or other than water based paints. So this is a promise and it is known as a warranty in the policy. We will see now some concepts in fire insurance such as MPL, maximum probable loss or maximum possible loss, and then PML, probable maximum loss. So MPL is maximum possible loss. This is the worst case scenario and the most pessimistic view. The entire building and everything inside could be destroyed. It is also known as shock loss or amount subject to loss or maximum foreseeable loss. It is an estimate without considering the fire protection devices, protective safeguards in place, construction material, size and occupancy. So to understand better, let us take an example of a godown building, a big godown building. So for fire protection, security guards are there, sprinklers are there, hydrant systems are there, fire extinguishing appliances are there. Further, the total single story building is compartmentalized into three. There are three compartments so that the fire normally will not spread from one compartment to another. So all these safeguards are taken. Still, if an engineer foresees 100% of the loss, then it is known as shock loss or it is the maximum possible loss. So in this estimation, we are not considering the fireproof walls or doors or hydrant systems or security guards. We are not giving any importance to these type of protection devices. But what can be the maximum loss? Worst case scenario, most pessimistic view. So that is known as maximum possible loss. Now another concept is that maximum probable loss or PML, possible probable maximum loss. So this is an estimate by giving due consideration to the fire protection devices, protective safeguards, construction material, size and occupancy. So it is inversely proportional to the size of the structure and the effectiveness of any protective safeguards. Better fire protection, the more likely a fire will be contained and extinguished before the entire building is destroyed. The occupancy and the contents within the building also affect the amount of damage likely to occur. So in estimating probable maximum loss or maximum probable loss, all these protection devices are taken into consideration. So here we know this particular building is separated into three sections and each section is protected by fire hydrant system, sprinkler system, everything. So I can estimate that at any point of time, even if the fire starts, it will not spread more than 33%, 1/3. And further, because of all these protection devices, the sprinkler will activate, hydrant systems are there, people are there. I can safely assume, okay, even if the fire starts, it may not even damage a single compartment. So we can contain the fire to maybe 20%. So that estimation is known as probable maximum loss. So that estimation is based on a type of calculation, what are all the materials stored within the godown and what type of construction is that, how much protective devices are there. All these factors are taken into consideration to arrive at an estimate. It is known as probable. See, to work out this probable maximum loss, normally in industries, three types of explosion scenarios are considered. One is unconfined vapor cloud explosion. Next is high pressure equipment rupture. Next is dust cloud explosion. Vapor cloud explosion means there can be, this is normally applicable in chemical industries or distilleries where a liquid form chemicals would have escaped from its containers and it would have formed a vapor. At any moment, because of a spark or a possible heat source, this vapor can explode, and when it explodes, it will spread through that gas environment very rapidly throughout the building. Entire building will be damaged. So this is known as vapor cloud explosion. So here the possibility of leakage, the types of chemicals used in the industry, and even if it leaks, how much vapor it can create, how much distance it can travel, all these matters. Next is high pressure equipment rupture. This normally happens in the case of a boiler or a high velocity or high speed equipments like a turbine. So when pressure increases than the estimated value in a boiler, it can rupture, it can cause an explosion and the concussion damages. So then an engineer can accurately calculate in the event of an explosion how much distance that pressure wave will travel, to what circle radius it will damage the equipment. So these calculations are done to arrive at a PML. Similarly, dust cloud explosion. In certain industries, because of generation of dust, fine dust will create a cloud, and any spark can create a huge explosion and it can travel to various areas of the building or industry. So it can cause a huge damage. So these damage scenarios are considered for calculating the PML. Now there is another concept known as PML burst or PML error. So in the same example what I told you earlier, in one building there are 3 compartments. So as a PML engineer, I calculate my loss will be 33%, minus I am giving an allowance to the security, hydrant systems, sprinkler systems. So I am calculating it may be contained to 20%. But unfortunately, on the day of fire, securities are on leave, sprinkler system did not work, hydrant system there was no power, so nothing worked out. Ultimately, it caused damages maybe to 100% of the property or damage to 50% or 60%. Anyway, it was more than my estimation of 20%. My estimation of loss, considering the all fire protection devices, considering the construction, considering the occupancy of the premises, was only 20%. But actual case, it exceeded that 20%. It went into 50%, 60% or 100%. This scenario is known as PML burst or PML error. An insurer or a reinsurer do not want to have a PML burst scenario at all, because there are 2 things. One is his premium rating totally depending on PML. So higher the PML, more is the premium rate. If chances of loss is more, we charge normally more premium. That is why chemical industries are having more premium rate compared to other industries. So there the probable maximum loss is more, so we charge more premium. This is one. Second point is that in the event of a PML burst, my capacity retention will be totally proved to be wrong. So I would have retained more, thinking that my loss scenario is only 20%. So instead of retaining 50% or instead of retaining 20%, sorry, instead of placing the business to reinsurers 60% or 70%, I would have placed only 20% or 30%. So this will have a big impact on my balance sheet. So considering the PML, normally all insurance companies underwrite the risk, which is known as RI underwriting, where they calculate their capacity, and the risk which is going beyond their capacity normally places with the reinsurers. So I will explain this, what happens in the event of a PML burst. For example, sum insured is 2500 crores and loss happens for 1000 crore. Now consider the 2 scenarios where it is, first thing, it is wrongly estimated as 30%. So going back to the previous example, because of 3 compartments and because of all fire protection devices, My engineer has estimated a PML of 30%. So that is 750 crore. See, please understand that whatever we are doing on our operating officers is the direct underwriting, where we accept the premium, we draft the policy and issue the policy. So there it is direct underwriting. We collect the premium. But simultaneously, there is one more system operates, or one more procedure is done, which is known as RA underwriting. So nowadays it is automized. System automatically do the reinsurance underwriting. So here let us assume the capacity of insurance company is only 700 crores plus 5% obligatory cession to GIC. So we are going little bit to the RI side. Let us assume an insurance company's capacity is only 700 crore PML and 5% obligatory. So in this example, my PML is 750 crore. So 5% of this 750 crore will go to obligatory. 150 crore, let us assume it is my net one. 350 crore I have a treaty with the reinsurer. 200 crore is my net 2. So total capacity is 700 plus 37.5, 737.5. The balance 12.5% I am placing with a FAC reinsurer. Here, people who do not have knowledge in RI, please understand that RI underwriting is done on PML basis, whereas our direct underwriting is done on sum insured basis. So that is why for each and every risk we assess the PML. As a thumb rule, we take it as 30%, or based on the GIC circular coming every year. So let us assume a thumb rule of 30%. So RI underwriting is done on PML basis. So each company will have a capacity PML. For example, till last year we had a capacity of 700 crores PML plus obligatory 5%. So if those capacities are utilized, this will be the RI underwriting. First 5% will go to obligatory, next 20% will go to net 1, next 47% will go to treaty, next 27 will go to net 2, balance 1% we have to place facultatively. That means at that point of time we have to find out a reinsurer X, Y or Z, and we have to place the risk. Now the risk is fully placed. 5 plus 20 plus 47 plus 27 plus 1 becomes 100%. Now let us say there is a loss of 1 crore. 5 lakhs will go to the obligatory, 20 lakhs will go to net 1, 47 lakhs will go to treaty, 27 lakhs will go to net 2, 1% will go to the FAC reinsurer, 1 lakh will go to the FAC reinsurer. So in other way, the way we are placing the RI underwriting, in the same proportion the loss also will be shared. It's a proportional arrangement. Now coming to the second example, correctly estimated PML. Suppose my engineer has estimated correctly 50% as PML. So that means it is 1250 crore. Now obligatory is 5%, net 1 is 12%, treaty is 28%, net 2 is 16%, and FAC reinsurance we have placed is 39%. Please see that the capacity remains the same. For 150 plus 350 plus 200 becomes 700. That is same in both example. It cannot change within an year. So, but you see the placement to FAC reinsurance is more. 39% we have placed as FAC reinsurance. So, in the event of a claim, 39% we can recover from the FAC reinsurer. We have to absorb only 12% of net 1 and 16% of net 2. 28% will go to the treaty reinsurer. So in this case, when there is a loss of 1000 crore, 5% we will get reimbursement from obligatory treaty, 28% we will get from treaty, 39% we will get from FAC reinsurers. Or in other words, what we have to absorb is only 12 plus 16, that is 28% we have to absorb to our balance sheet. Of course, it is further protected by risk excess of loss treaty, and I am not going into detail. So in the second example, when the PML is correctly estimated that 1250 crore, the loss is well within that PML. Loss is not exceeding the PML. Loss is only 1000 crore. So in that case, only 12 plus 16, 28% of 1000 crores will come to the insurer's balance sheet. Whereas if the PML was wrongly estimated, out of 1000 crore, 20 plus 27, 47%, that means 470 crore will come to the balance sheet of the insurer. So this is a very what you call frightening scenario. So PML burst should not happen. That is why insurance companies are taking due care while underwriting the policy, while assessing the PML. The design of a fire policy. A fire policy may be issued for single location, single occupancy, single block, single property, or multi-location, multiple occupancy, multiple block, and multiple property. So this is the way we design our fire policy. This figure, the outer box represents the policy. So within that policy, you can have several locations: location 1, location 2, location 3, location 4, and n number of locations. So there is no limit. So one policy can cover multiple locations. Now coming to location 1. Within one location, you can see there can be different occupancies. Occupancy 1, occupancy 2, occupancy 3, and occupancy n. N number of occupancies. For example, you take the case of a sugar mill compound. Sugar is one occupancy. So after extraction of sugar, the molasses what is left out will be given to the distillery industry. So that is occupancy number 2. So there the molasses is fermented and then distilled to make rectified spirit. Then whatever remaining is known as spent wash. Spent wash is given to the next occupancy, which is bio fertilizer. So that is occupancy 3. And again there in occupancy 3 they manufacture the fertilizer. Now again whatever coming out of the sugar mill at the initial stages of crushing operation, that bagasse or sugar cane is crushed. After extracting the juice, it is known as bagasse. So that bagasse is given to the next occupancy, which is a power plant, where the bagasse is used as a fuel in boiler, and with the help of that boiler converts water into steam. Steam is given to the turbine and power is generated. The power is utilized for running the sugar mill, distillery, and fertilizer unit, whatever power requirement within the location, or they can export to the outside location also. So within that one compound, there can be different occupancies: sugar, distillery, biofertilizer, cogeneration plant, power plant. So now take one occupancy, let us say sugar plant. Within sugar plant, there can be different blocks. Block 1 can be a production block, then block 2 administrative block, block 3 residential quarters. So several blocks can be there. But please understand that here within one location, within one compound, different occupancies will attract different rates. Sugar mill will have one rate, distillery will have another rate, biofertilizer will have another rate, cogeneration plant will have another rate. And within one occupancy, though there are different blocks like administrative block and then maintenance block, production block, all these blocks will attract one occupancy rate. There is no differentiation except dwelling. Dwelling can be rated as a separate occupancy. Now coming to one block, production block, again the sum insured can be split into building, including plinth and foundation, building only superstructure, only plinth and foundation, then plant and machinery, FFF, and electrical installation, then stock, different types of stock and specific items. So these are all the properties within the block. So this is how a fire policy is designed. It can be multi-location or a single location. It can be multiple occupancy or a single occupancy. It can be multi-block or a single block. It can be a single property or multiple properties. Now let us see fire insurance claims. Fire insurance claims give tangible shape to insurance contract. See, insurance contract is a promise on paper that insurance company indemnify the insured in the event of a loss. But it is having a practical meaning in the event of a claim. What will happen in the event of a claim? Insurance contract is only a promise. The actual effect of the promise will come only in the event of a claim. Now, there are certain conditions in the policy which are relevant to claims. For example, condition number 1, which talks about misrepresentation, misdescription, non-disclosure. So this makes the policy void. If there is a misrepresentation, then the policy becomes void. Then condition number 2, policy shall cease on expiry of 7 days from the date of fall or displacement of any building. Condition number 3, trade alteration. This I have already explained. Then insurable occupants, insurable interest, that also comes under condition number 3. Unoccupied property, if it is unoccupied for more than 30 days, then insurance automatically terminates. Then marine policy pay first, that is condition number 4. And there is one more condition for cancellation, condition number 6. Insured to notify the insurer of a loss within 15 days, submit details, provide plan specification, etc. at his own expenses. Whatever documents required to prove the claim, he should submit. Declaration of the truth of the claim. Company shall not be liable after expiry of 12 months from the date of loss unless claim is pending action or arbitration. So after 12 months, that is the time frame. If the claim is not pending for settlement or it is not pending with arbitration, then the time period lapses. Condition number 7. On the happening of any loss, the insurer may enter, take and keep possession of premises, take possession of any property on premises, arrange, sort or examine the property, dispose of such property. Insurer can exercise this right till the claim is finally determined or withdrawn by insured. Insured cannot compel the insurer to incur any liability to the insured or abandon the property. So after the loss, insurer is having certain rights. So he can always enter, take possession of the property, arrange and sort the material, dispose of the property, unless otherwise claim is withdrawn by the client. So at any point of time, insured cannot abandon the property. Condition number 8 talks about fraud. In the event of a fraud, claim is not payable. And condition number 5 is the basis of settlement, how the claim is settled. Then condition number 9, to elaborate, company can even reinstate the property in a reasonably sufficient manner and then insured to submit relevant documents. An act by company cannot be deemed as election by company to reinstate. If due to municipal or other regulations, reinstatement is not possible, the cost of reinstatement will be paid to the insured. So these are all the rights of the insurer. In the event of a settlement, company can even opt for replacement or reinstatement of the property instead of giving the indemnity. Condition number 10 talks about average clause. I have already explained what is average clause. Condition number 11 is contribution. Condition number 12 is subrogation. Condition number 13 is arbitration. The most disturbing condition in the policy as far as insurers are concerned nowadays. Condition number 14 is reinstatement of sum insured. 5 is reinstatement of sum insured. Condition number 14 is any notice to be in the form of return to the insurance company. Survey fees as per norms to be paid to the surveyor. Salvage disposed of as per procedure laid down. I think you are aware of the CVC guidelines. Financial limits prescribed and claims settled as per financial limits. See, whenever we settle any property claim, we have to follow this principle of RD safer. So any property claim will be settled in this order only. For example, there is a damage to a machinery. So first we have to find out what is the reinstatement value. How it will be found out? From the latest invoice or bill of the machinery. So you can find out what is the current replacement value or reinstatement value. If it is a building, the current construction cost of the building from a quotation, or after construction there will be bills and invoices. So from that you can accurately find out what is the current reconstruction or replacement or reinstatement value. Next step is depreciation. Depreciation is decided by the surveyor based on the usage of equipment or the building, and this depreciation is deducted from RIV to find out the market value. Please note that if the policy is issued on RIV basis, then this step is omitted. That means there is no depreciation. Next is salvage. Salvage is deducted from market value. Actually, to dispose the salvage, we may have to incur some expenses like newspaper advertisement or expenses related for segregation. So these expenses are deducted from the salvage, and that net amount is deducted from the market value. Please note that these expenses should not be paid in full at the end of the claim calculation. That is wrong. It should be deducted from the salvage, then the net amount should be deducted from the market value. Next step is average clause. You are aware what is underinsurance or average clause. Loss into sum insured by sum to be insured or value at risk. Next is franchise, which is not applicable for fire policies. Only in certain types of miscellaneous policies it is applicable. Next is excess. We have discussed the excess in detail. It is as per the guidelines. So next is reinstatement value. So once the loss happen during the policy period, it is mandatory to reinstate the sum insured to its original value. So see, for example, in a mediclaim policy, if you have a sum insured of 1 lakh and one admission you have incurred, let us say 30,000, the balance sum insured available in the policy is only 70,000. So for next admission for a disease, you can utilize only 70,000. This is the case with mediclaim. Whereas in property insurance, in fire insurance, in the event of a loss, after during the settlement of the loss, we deduct a value known as reinstatement premium. So reinstatement premium is deducted from the claim amount itself, so that whatever claim we are paying, to that extent the sum insured is reinstated. For example, total sum insured is 100 crore. There is a claim of 10 crore. That means the balance sum insured is 90 crore. When you are collecting the reinstatement premium, then this sum insured is reinstated to the same value, that is 100 crore. So to the extent of 10 crore, we calculate the premium to be payable and it is deducted from the claim amount. Please note that it is the duty of the insurer to deduct this amount. Whether you are deducting this amount or not, sum insured remains intact. So in the event of a claim for 10 crore on particular day, the next day again the insured can claim up to 100 crore. So there is no reduction of sum insured as such during the policy period. It is the duty of insurer to calculate this reinstatement premium and deduct from the claim amount. Whether we are deducting or not, sum insured will be the original value for subsequent losses. So how reinstatement premium is calculated? Reinstatement premium is equal to loss, whatever loss, into policy rate into pro rata number of days. So if a claim happens on 100th day, then the balance period 365 minus 100, 265 divided by 365 into policy rate into loss will be the reinstatement premium. Now coming to one major policy in fire portfolio, it is known as industrial all risk insurance. I think I have already discussed what is an all risk cover and what is a specified perils policy. So SFSP is a specified perils policy, whereas industrial all risk insurance is an all risk policy. So it is driven by exclusions. Only exclusions will be listed in the policy. So other than exclusions, everything is covered. So it is an all risk policy. So normally it is issued for sum insured more than 100 crores and above for industries. But nowadays IAR people are issuing for less than 100 crore also. So it depends on each company's filing and guidelines. Of cover, it is a package policy covering fire and allied perils, burglary, machinery breakdown, boiler explosion, electronic equipment, business interruption due to fire and special perils policy, and machinery loss of profit. Actually, this industrial all risk policy is having 3 sections. Section 1 is material damage. So that section is all risk. So under section 1, the policy covers fire, allied perils, burglary, machinery breakdown, boiler explosion, electronic equipment insurance. So all risks are covered under section 1. Now section 2 is FLOP, fire, loss of profit, business interruption due to fire and allied perils. And section 3 is MLOP, machinery loss of profit. That means consequential losses due to machinery breakdown or boiler explosion. Section 3 is optional, whereas section 1 and section 2 are compulsory. Now sum insured in this policy should be RIV, reinstatement value. For underinsurance, sum insured is compared with the value at risk as on date of reinstatement. So this is same as any type of RIV policies. Sum insured is compared with the value at risk as on date of reinstatement. Whereas in market value policies, sum insured is compared with the value at risk as on date of loss. That is a major difference. And underinsurance is waived if it is less than 15%. So if the underinsurance is 14%, then it is waived. So full claim is payable. But if the underinsurance is 16%, then 16% underinsurance is applicable. So it is like a barrier. Up to 15%, no underinsurance. More than 50%, full underinsurance. MPD sum insured for premium calculation need not include value of pipes and cables. So whatever value of pipes and cables you can deduct from the plant and machinery sum insured, and then the premium can be calculated. That means Pipes and cables are covered under the policy without any premium, free of cost. It does not mean that pipes and cables are not covered under the policy. Pipes and cables are covered under the policy. Sum insured, total sum insured represents the sum insured of pipes and cables also, but you need not charge the premium for that particular portion of the sum insured. It is free. There are exclusions. I told you this policy is driven by exclusions. So major exclusions are faulty material, workmanship, defective design and material. So here faulty material, workmanship or defective design and material are excluded, but whatever losses ensuing due to this faulty material or defective design are payable. So only that particular property what is damaged by defective design, material or workmanship is not payable under the policy, but all the other ensuing damages are payable. If you have knowledge on engineering insurance on DE1, DE2, DE3, DE4 and DE5, here the coverage is up to DE3. That means that property where the defective material is there, that is not payable. Other than that, all surrounding properties or all connected properties which are damaged due to this defective material or design are payable. Only the property where the defective design, material or workmanship is identified, that property is excluded. Now inherent wise, defects, deterioration, normal wear and tear. So these are all exclusion under any policy. Collapse or cracking of building without any reason, it is specifically excluded without any peril. Pollution, contamination, shrinkage, rust, corrosion, scratching and temperature changes. So without any peril, if there is a contamination or pollution, then it is excluded. But as in fire policy, if it is followed by a peril or if fire peril followed by pollution contamination, both cases pollution contamination are payable. Rust and corrosion are normal, gradually developing defects which are not payable. Larceny, fraud, dishonesty, inventory losses, shortage on delivery, willful act, negligence, war and nuclear risk, these are all exclusion under any policy. Till now we were discussing about SFSP and other policies variations like declaration, floater declaration, then IAR. So normally SFSP and fire declaration or floater policy covers material damage to any subject property or matter which is covered under the policy. So in the event of a calamity and subsequent damage to the property, the insured suffers two types of damages. One is the capital loss. His building is damaged, his plant and machinery is damaged, so he has to incur additional expenses to reinstate the building or replace the property. That is one type of losses. Second type of losses is the business interruption losses, whereby as the property is not there, as the plant and machinery is not there, he will have an interruption in his business. The production activity will be hampered. He has to stop production. So thereby his turnover is reduced, and in turn his net profit is also reduced, or his gross profit is also reduced. So that is another type of losses. These type of losses are known as consequential losses or business interruption losses. So we have policies to cover these type of losses also. Commonly it is known as business interruption insurance or loss of profit insurance. So it covers loss of anticipated profit, NP, continuing trading expenses, that is normally known as standing charges. So standing charges and net profit. Then further it covers increased trading expenditure, which is known as increased cost of working. Let us see in detail. So it provides compensation for loss of earning power, while MD policy like an SFSP policy covers capital losses. Let us take an example of a bakery. So sales of 500 loaves of bread, rupees 4 per loaf per day. So he is making 2000 per day. This is known as turnover, the sales turnover, and his expenditure per day is 20 kilogram of flour, wheat flour at 20 per kilogram. So total expenditure is 400. This expenditure is for the raw material, or these expenses are known as direct expenses. But you see there are some indirect expenses which we call in insurance standing charges, like rent 2500 per month, salary 3000 per month, electricity 1000 per month, other expenses 1500 per month, total 8000 per month. Now if you convert to monthly income and expenditure, monthly turnover is 60,000 rupees and monthly raw material cost is 12,000 rupees. Monthly indirect expenses or standing charges is 8,000 rupees. So net profit is arrived by turnover minus variable charges minus standing charges, that becomes 40,000 rupees. So what will be the loss to the bakery if it is closed for 30 days? That means 1 month he will lose the net profit and he will have to continuously incur the monthly expenditure of 8,000 because the rent he has to pay, the salary he has to pay, the electricity charges he has to pay whether there is production or not. So these expenditure which are known as standing charges or indirect expenses which will continue to incur even though there is no production, so that is also a loss. So his total loss is gross profit 48,000. So this method of finding out the gross profit is known as addition basis. Here we are adding net profit to the standing charges. There is another method to find out the gross profit. This is known as difference basis. Sales 60,000 minus raw material cost 12,000. This will give you gross profit. This is known as difference basis. So here please understand little bit accounts part of it. Turnover plus closing stock minus opening stock is equal to variable expenses or raw material expenses plus indirect expenses or standing charges plus net profit. So this is a simple equation we have to remember. Turnover plus closing stock minus opening stock is equal to variable expenses plus standing charges plus net profit. In this equation, standing charges plus net profit is known as gross profit, GP. So turnover plus closing stock minus opening stock is equal to variable expenses plus GP. So gross profit can be found out by two methods, addition method and difference method. In addition method it is net profit plus standing charges, and difference basis it is turnover minus variable expenses. So insured has to declare the basis of finding out the gross profit in the policy, whether it is on addition basis or difference basis. So in difference basis it is found out by turnover minus variable expenses. So in that case all standing charges are deemed to be covered. 100% of the standing charges are covered in this method. So that is the safest method for insurance. Whereas in addition basis he can select the standing charges. In some of the industries standing charges will be 1000 in numbers. So he need not or he does not want to insure the full standing charges. So he is selecting 10 standing charges out of 1000 standing charges. So then we call it as insured standing charges. So then the gross profit is insured standing charges plus net profit. So he do a selection of standing charges and then net profit is added to arrive at a gross profit. Now in the event of a claim, we will pay only net profit and the insured standing charges. Uninsured standing charges are not paid. So that is the difference between addition basis and difference basis. In addition basis, insured can select the standing charges. When he is making a selection, he should declare what type of standing charges he wants to insure under the policy. There should be a list of standing charges covered under the policy attached with the policy. In the event of a claim, we will pay only those insured standing charges and the net profit. Whereas in difference basis, 100% standing charges are deemed to be insured. He is arriving at gross profit by just deducting the variable expenses from the turnover. So all standing charges are covered. In the event of a claim, all standing charges and net profit are payable. So that is a more safe method of doing it. Anyway, insured has to declare the modus or how he is arriving at the gross profit, whether it is on addition basis or the difference basis. Now coming to the net profit. Net profit is net trading profit exclusive of all capital receipts and accretions and all outlay properly chargeable to capital resulting from the business of the insured at the premises after due provision has been made for all standing and other charges including depreciation but before the deduction of any taxation chargeable on profits. So the definition is slightly lengthy. We have to understand that while calculating the net profit, we need not consider the capital outlay or capital received for the current year. So that is to be excluded. And again, the net profit of the particular premises only to be considered. And all standing charges also to be considered, including depreciation. Let us bifurcate factors considered, factors not considered to arrive at net profit. Net trading profit arising exclusively from the business of the insured at the premises expressly stated in the policy. So what is stated in the policy, the location, from that location what net trading profit he is generating, that is to be considered. Net trading profit is that remaining after all provisions for cost of production, charges incurred for running the business, etc. Then depreciation is considered, property taxes are considered as standing charges. Then factors not considered are net profit or loss from other activities such as sale of investment, sale of property or building. So this is not related to the actual business of the insured, production activity of the insured. So that is not considered. Income from property or investment, that is also not considered. Capital expenditure or outlay on new plant and equipment, so that is not considered while calculating the net profit. Income tax and profit tax are not deducted. So net profit including the income tax component and profit tax component. Now what do you mean by standing charges? Standing charges, otherwise call it as indirect expenses. See, there are many expenses related to a production process. Mainly you can categorize it into two. Expenses which are directly proportional to the turnover, which is known as variable charges. So when production or turnover is less, these expenses are also less. For example, let us assume a tea shop where they are manufacturing tea. So if there is a loss and tea shop is not producing any tea, then expenditure towards sugar, expenditure towards milk, expenditure towards fuel are nil. So expenditure or expenses which are directly proportional to the turnover are known as variable expenses. So when the turnover becomes zero after a loss, these expenses also become zero. So insured is not having any worry about this expense. What worries the insured is the standing charges. These expenses are not proportional to the turnover. Though the turnover is zero, the expenses remains the same. For example, he has to pay the wages, he has to pay the salary, he has to pay the rent, he has to pay a portion of electricity charges, he has to do the repair and maintenance, he is incurring administration overheads, factory overheads. So these are the expenses which are not related to the turnover at all. These expenses are known as fixed expenses or indirect expenses or standing charges. These are all examples of standing charges, selling overheads, interest and depreciation. So example of variable expenses are raw material cost, power and fuel, excise duty, wages of piece rated workers, sales commission, stores and spares. These are variable expenses which decreases or which decrease proportionately with production or sales. These are called specified working expenses under a LOP policy. Variable costs are called working expenses by insurers. Fixed costs are called standing charges by insurers. So this I have already explained how to calculate contribution or GP. There are two methods, fixed cost plus net profit or fixed cost minus net loss, sales minus variable cost. Sales minus variable cost is known as difference basis. Fixed cost plus NP or fixed cost minus net loss is known as addition basis. So an industry can make net profit or net loss. In both the cases, we can issue a fire loss of profit policy. So in the second case, when he is making net loss, the GP will be fixed cost minus net loss. But if the company is making a gross loss, that means his turnover is not enough to serve the variable expenses. It is not, they are not able to meet the variable expenses or raw material cost itself. That means company is making a gross loss scenario. In that case, we cannot issue LOP policy at all. Now what is gross profit? Insured standing charges plus net profit or insured standing charges minus net loss. I told you earlier, in the event of addition basis gross profit, insured is having an option to select the standing charges. So if full standing charges are not insured, then the second scenario becomes, that is GP is equal to insured standing charges minus net loss. So if full standing charges are not covered, then full amount of net loss need not be deducted from the standing charges. It should be deducted only in proportion. For example, only 50% of the standing charges are covered, then GP is equal to insured standing charges minus 50% of the net loss. That means net loss into insured standing charges divided by total standing charges. So if he is having an intention to cover only 50% of the standing charges, then insured standing charges minus that portion of net loss, 50% of net loss. In other words, the formula is slightly modified when there is a selection. Now what is payable under LOP? In LOP, claim is payable for loss of GP, then ICW, increased cost of working incurring, less any savings in standing charges. If insured is saving in any of the standing charges, those savings will be deducted from the net claim amount payable. So LOP claim payable is equal to 1 plus 2 minus 3. Loss of GP plus ICW minus any saving in standing charges. Now we will analyze each of these component. What is loss of GP? Loss of GP is equal to rate of GP into loss of turnover. See, let us assume there is a fire in the industry and there is an interruption. Interruption means after the fire, the insured will take some time to reinstate the building or reinstate the plant and machinery. Let us say it is 6 months. So during that 6 months, there is not production, there is not turnover. So that period is known as interruption period. So during the interruption period, turnover may come to 0 or it may be less than the actual turnover. So that difference is known as loss of turnover. So loss of GP is calculated by rate of GP into loss of turnover. So what is loss of turnover? Loss of turnover is standard turnover minus turnover during interruption period. What is standard turnover? Standard turnover is the turnover for the corresponding period during the last financial year. For example, if there is an interruption period of 3 months, January, February, March. January 1st is the date of loss and there is no production for January, February and March. 3 months. Standard turnover is the turnover for the January, February, March of the last financial year. So that standard turnover is compared with the turnover during the interruption period of, that means current year, January, February, March. Turnover can be 0 or turnover can be a percentage of the actual turnover. It can be 50%, it can be 30%, 40% or even 80%, whatever may be the turnover. It is not the full turnover. After the loss, since there are some losses, insured wants to replace or repair the machinery, so turnover naturally will come down. It may be nil turnover also due to the total loss. Whatever may be the case, loss of turnover is equal to standard turnover minus turnover during interruption period. So turnover during interruption period can be 0 or a part of the actual turnover. Standard turnover is turnover for the corresponding period in the previous year. Now what is rate of GP? Rate of GP is a term used in accounts. It is last financial year GP by last financial year turnover. It is basically a ratio of GP by turnover. So both components are known. Now you can calculate what is loss of GP. Next is ICW or increased cost of working, which is payable subject to a maximum of loss of GP thereby saved. So increased cost of working means, let us assume in our operating offices there are 10 computers and let us say 5 computers are damaged in flood. So from next day onwards, our output will come down by 50%. 5 computers are gone. Now divisional manager takes a decision to hire let us say 3 computers so that our production is maintained to at least 80%. 50% damage, 30% retained or hired. So we are getting 80%, still 20% loss is there. So this hiring charges is known as increased cost of working. So thereby we are trying to maintain the turnover, thereby we are trying to save the GP. So these hiring charges, increased cost of working is payable subject to a maximum of economic limit. That limit is how much GP you are saving. For example, we are incurring 10 lakhs for hiring the equipments. Thereby we are saving 15 lakhs GP. Then 10 lakhs is payable. If we are incurring 10 lakhs but GP saved is only 5 lakhs, then only up to 5 lakhs claim is admissible. That is known as economic limit. And ICW is also subject to underinsurance when all the standing charges are not covered. Then ICW amount payable is equal to ICW into insured standing charges by total standing charges. In that ratio only we will allow. Now again, LOP policy is also subject to an average clause. Average clause is sum insured by annual GP. So actually insured should select annual gross profit as the sum insured, anticipated gross profit for the current year. Sum insured in LOP policy is GP, gross profit. So insured should select annual or anticipated GP for the current year as the sum insured. But when the claim happens, surveyor compares the sum insured with the annual GP achieved, and if there is underinsurance to be applied, it is applied in this ratio. Now let us see some example how to calculate LOP claim. There are two scenarios, before fire and after fire. Turnover before fire is 50 lakhs, after fire is 25 lakhs. Protection cost before fire is 35 lakhs, that is 70% is the variable cost. After fire, that ratio remains the same. Since turnover is 25 lakhs, raw material cost is only 70% of 25 lakhs, that is 17.5 lakhs. Standing charges was 10 lakhs, that is 20%. Standing charges will not change. Standing charges are charges which are not proportional to the turnover. It remains the same, 10 lakhs. So it becomes 40% of the turnover. Now net profit in the first case is 5 lakhs. 50 minus 35 minus 10. So net loss in the second case is 2.5 lakhs. 25 minus 17.5 minus 10. So he is losing 2.5 lakhs plus whatever net profit he was generating, 5 lakhs, that is also lost. Now GP is equal to net profit plus standing charges. So 5 lakhs plus 10 lakhs, 15 lakhs is the sum insured in the policy. Ratio of GP to turnover is 15 lakhs by 50 lakhs is 30% is the GP. Shortage in turnover is 50 lakhs minus 25 lakhs. Turnover before fire, turnover after fire. So 25 lakhs is the shortage in turnover. Shortage in GP is 25 lakhs into 30%. So that is 7.5 lakhs. So 7.5 lakhs is paid as a claim under LOP. This 7.5 lakh will go into 2.5 lakh net loss and 5 lakh net profit. Ultimately, when the insurance company pay a claim of 7.5 lakhs, the insured will make a net profit of 5 lakh, which is the same position, same financial position before the fire. So the intention of the policy is to lift the insured to the same financial position. So he is getting again the net profit of 5 lakh with the help of insurance. Chain of events that lead to a claim in LOP. Premium to be paid, damage to be there, interruption of business, then loss due to interruption. Now what do you mean by indemnity period? The period commences from date of fire or peril and ends when the business ceases to be affected thereby, subject to a maximum period specified in the policy. So means indemnity period starts with the date of loss and it ends with the date when business ceases to be affected thereby. That means the date on which turnover reaches the previous level before the date of loss. So after the loss, definitely the turnover would have come down or would have come to zero. And the date on which the full reinstatement is completed and the turnover reaches the initial position before the loss. So that date it ends. And subject to a maximum period specified in the policy. Sometimes, let us say the period specified in the policy is 12 months. Sometimes the interruption period can prolong after 12 months. So the reinstatement may take 15 months or 18 months. Still, for the claim calculation, we will take a maximum period that is specified in the policy. Second scenario is that the interruption may be lesser than the period specified in the policy. For example, the reinstatement would have completed within 6 months and client would have started the production. He would have reached the turnover of previous or pre-loss stage within 6 months. Then the period taken for calculation is only 6 months. Another concept is deferred indemnity period. So after the date of loss, the indemnity period commencing at a later date than the date of damage. For example, it is a silent risk. So during silent risk, there is no production, there is no turnover. So even if there is a damage, it is not going to trigger an indemnity period. Even before the damage, there was no turnover. But the client was having an intention to start the production after 30 days. Let us say there was a gas shortage in a gas power plant. After 30 days, he is supposed to get the gas and gas is available. But now he cannot start production because there is a loss. So this creates a situation of deferred indemnity period. So this is normally not allowed, but in certain cases we are allowing as an add-on cover under the policy. There is a concept known as accumulated stock clause. This is applicable when the manufacturer's stock of finished goods is depleted in reducing or eliminating the shortage in turnover during the indemnity period. If this clause is attached, the above factor is considered while claim settlement. In adjusting any loss, account shall be taken and an equitable allowance made if any shortage in turnover due to the damage is postponed by reason of the turnover being temporarily maintained from accumulated stocks of finished goods in the insured's warehouse. For example, insured's turnover, let us say it is 300 units per month. Now let us say he is keeping a stock of 900 units in his godown. Now after the loss, insured is having an option to sell from the stock already he is having. So he is having 900 units stock. Let us say he is selling this accumulated stock. So he is maintaining the turnover for 3 months. Meanwhile, the repair work is complete and turnover reaches to the previous level. So ultimately, for the calculation of claim, in this case, there is no loss of turnover. 3 months there was no production, but 3 months turnover was maintained by stock he was already having in store. So ultimately there is no loss of turnover, there is no claim in the policy. But what will happen after that 3 months, once he depletes everything from his stock, then during the indemnity period he may suffer a loss. Even if there is a small production, he cannot utilize anything from his accumulated stock. Ultimately, what insurance company will see, if there is a clause, accumulated stock clause in the policy, if there is no clause, nothing is payable, matter over. If there is an accumulated stock clause in the policy, and if he depletes that whatever stock he has accumulated, and within that indemnity period he suffers a loss due to reduction in turnover by whatever cause, he is not able to use that accumulated stock. So that whatever he has utilized from the accumulated stock, to that extent insurance company indemnifies the loss. So he has utilized 900 units, so insurance company pay that 900 unit provided he suffers a loss within the indemnity period. Suppose within the indemnity period there is no loss and he is able to replenish the stock in the godown, that means he is having an excess production. So he is not suffering any loss, then the claim is not admissible. But within indemnity period, he suffers a loss even after the actual interruption period because he is not having any stock in the godown. Ultimately, his turnover is affected, then the claim is admissible. Now coming to the another clause known as departmental clause. This clause says that if insured business is conducted in departments where independent trading results can be ascertained, loss of GP shall be calculated independently for the department affected by the loss based on its trading results. If more than one department is affected, BI loss shall be computed for each department affected by loss. But this would be subject to a condition that if the sum insured under the policy is found less than the sum total of gross profit of each department, whether affected or not, then the payable amount shall be reduced proportionally. That means it would attract under it. So if the insured is carrying out business in different departments, and if one department if suffers a loss, in the absence of this departmental clause, if departmental clause is not attached with the policy, then if his turnover is maintained by other departments, then for insurance company there is no turnover loss, no claim. But if departmental clause is attached, then the results of different departments are treated separately. So loss of GP in one department, though it is maintained by other departments, it will not be considered. So loss of GP for that particular department will be paid as insurance claim. See in detail, this means insured must have more than one production block or units in one compound. Each department or section production block must have proper accounting system to evaluate their respective gross profit. In the event of a loss in one department, section or unit, loss of GP shall be computed considering reduction in production based on accounting figures of affected section or department. But the adequacy of sum insured shall be checked by comparing the declared sum insured with the sum total of GP of all departments at the time of loss, whether they are affected or not. Let us assume that a risk has three departments A, B and C. Block A suffers a loss. However, production has been increased in B and C to compensate the loss in A. So department A, B, C before loss and after loss. A was producing 100 and after loss it is 50. Let us say this is the GP contribution. 100 crores before loss, 50 crore after loss. And contribution of department B is 100 crore before loss. It has been increased to, let us say, 125 crore. Similarly in C, department C it was 50, it is after loss it is increased to 75. So total before loss and after loss if you compare it is 250. So normally LOP claim payable is nil without department loss, because we will tell there is no reduction in turnover, there is no loss of GP, nothing is payable. But if department clause is attached, then we pay the claim up to 50 crore. That means the difference in first department, department A, 100 minus 50 is payable without considering the increased production in department B and C. Provided all these departments should have separate balance sheet or it is ascertainable. Accounts details should be ascertainable. Then the loss of department A is payable though there is an increased production in B and C, that is not considered. So this figure shows how we are calculating standard turnover, what is last financial year turnover, what is annual turnover, what is indemnity period. Let us assume the current year is 2015 and there is a loss in 1st of June, that blue color shaded region, and the interruption period is June, July, August up to 31st of August, 3 months interruption. Now what is standard period is the corresponding period of the interruption period in the last financial year, that is June, July, August of 2014 is the standard period. So last financial year turnover is actually from previous March to up to April, that is the last financial year corresponding previous financial year, that is the last financial year turnover. What is annual turnover? Annual turnover is the turnover for 12 months just prior to the date of loss. That is 12 months you have to take backwards from the date of loss 1st of June. So that turnover is annual turnover. See why that is taken? See, annual turnover gives a clear picture how the business is going, whether it is a growing trend or it is a declining trend, because the annual turnover is the turnover for the 12 months just before the date of loss. So it will give a clear picture of what is happening in the business. Now in the previous slides we have explained how the loss of GP is calculated. It is calculated by comparing the standard turnover with the turnover during the indemnity period or the interruption period. Then it is multiplied with the rate of GP to find out the loss of GP. See here the standard turnover, it is not merely the turnover during the period corresponding with the indemnity period in the previous year. So normally standard period is adjusted for the trend of business. Standard period is adjusted for special circumstances in the business or the variations in the business. For example, a business is having a trend of growth, 10% growth. Then the standard turnover, we would have got 10% extra during the interruption period because the trend, growing trend is there. So that trend is taken into consideration. Similarly, if it is a negative trend, a declining trend, then the declining trend also to be considered. So we are not expecting the same turnover during this current year. there will be a decline of business. So that trend is to be considered and it is to be applied on the standard turnover. Another thing is special circumstances. For example, 2014 June July there was a strike in the factory. So standard turnover will be turnover for only August. So that is not a correct method to compare only August turnover to June July August turnover of 2015. So the strike may not repeat in June July of current year. So that is a special circumstances that is avoided, and an average of June July August is taken, or extrapolation of May will be done to June July and find out the 3 months standard turnover and then compare with the interruption period. Similarly, during the last year June July August there were only 3 machines. Now during 2015 for protection he has added one more machine. So that is a variation or special circumstances. So that addition of machine also to be considered and adjusted with the standard turnover to find out what is the anticipated turnover during the interruption period. So these adjustments of trend and special circumstances is done on the standard turnover before calculating the loss of GP. This trend adjustment is also done in the rate of GP also. Now this is how LOP claim is worked out. Though it seems to be very simple calculation, there are several factors will come into picture in the event of actual claim. So surveyor will do all those adjustments and ultimately pure indemnity is arrived at. Now I will talk about one more scenario. It is known as contingent BI. See, the first condition in LOP policy to pay a claim is that there should be a material damage claim. It is known as material damage proviso. For example, in a particular location, if there is a flood or a fire, to pay the LOP claim, first the material damage claim should be established. But nowadays we are giving certain add-on covers whereby material damage proviso is not complied. So that means there need not be a material damage claim in the location where we are considering the LOP claim. So this scenario is known as contingent BI. These are the some of the cases where contingent BI will trigger. For example, prevention of access. This is normally given with a maximum limit of 30 days over and above the policy time access and with maximum radius of 5 kilometers from the insured premises and only inland. This extension is available only for normally mega policies. For example, this is an additional cover where material damage proviso is not complied. So it is known as contingent BI. There is no damage to insured premises, but within 5 kilometer radius of insured premises, that area may be owned by the insured, may not be owned by the insured. There is a peril and there is a damage. For example, there was a bridge and the bridge is collapsed due to heavy flood. So there is a damage within the 5 kilometer radius, but there is no damage to the insured premises and thereby access is prevented. So employees cannot come and work. So turnover is affected. So this coverage is given up to a maximum period of 30 days. Here please understand that there is no damage or to insured premises, but there is a damage due to peril within the 5 kilometer radius of insured premises. Then the coverage is given for a maximum period of 30 days. There is another cover known as denial of access, ingress or ingress. These are all not covered. Here the difference is denial of access by a public authority. Peril is not there, damage is not there, but anticipating a flood, anticipating a peril, the access is denied. So there is no peril, no damage, but access is denied and there is a protection loss. This is not covered under the policy. Next case is supplier premises or customer premises or utilities extension. So the coverage is given like this: named customers and suppliers for a maximum limit of 20% of the BI sum insured loss limit. Coverage to be restricted to 20% of the BI sum insured or a particular loss limit he can choose. Coverage is to be restricted to Flexa perils for overseas customers or suppliers and to be restricted to Flexa and AOG perils for domestic customers and suppliers. Unnamed customers and suppliers located in India for a maximum limit of 10% of the BI sum insured or a loss limit, and coverage is restricted to flexa periods only. No cover for unnamed customers or suppliers. So here we have to understand that for a particular insured, he is having several customers and suppliers. So he is getting raw material from his suppliers. His finished goods are given to his customers. Now let us assume there is a loss to one of the suppliers' premises. So he will not get his raw material. So his production will be affected, turnover will be affected, there will be a loss of GP. Here there is no material damage to insured premises, but there is a peril and material damage to suppliers' premises. So thereby there is a loss of GP. So that can be covered under this extension. Similarly, there is no damage or peril to the insured premises, but there is a damage in the customer premises. So his finished goods are not being able to supply to the customers. So there is no demand and turnover is hampered and GP, there will be a loss. In both these scenarios, there is no peril acting on the customer premises, on the insured premises. But peril and damage is there either on supplier or on customer premises. And again, this customer can be named customer or unnamed customer. Similarly, suppliers. Again, the customer and supplier can be within India, domestic or foreign countries. So all these scenarios combined, the coverage is given, but it is a restricted cover. For example, if named customers, named means name should be specified in the policy. Named customer and named supplier, if it is located in India, then coverage is given up to a maximum of 20% of the actual BI sum insured. And coverage will be for flexa, that means fire, lightning, explosion and aircraft damage, and for AOG perils, act of God perils. We are not giving full cover. Cover is restricted, flexa plus AOG, and limit is 20% of the BI sum insured. If the named customer and supplier is not in India, he is in abroad or overseas, then the coverage is restricted to flexa perils. At the same time, if the name of customer and supplier is not given, n number of customers and suppliers without name, within India, coverage is given 10% up to BI sum insured, but only flexa peril. And if it is unnamed customer, unnamed supplier not located in India and overseas, that means there is no cover at all. Similarly, for public utilities, public utility means water, fuel, gas or electricity. If there is a shortage to these items to the premises due to any of the insured peril, and then the production is affected, gross profit is affected, coverage is given up to 10% of the BI sum insured. And these limits specified are aggregate across all customers and suppliers and public utilities. See now, as per GIC treaty, this coverage is restricted to 1000 crore for named suppliers and Indian domestic supplier and customer, and 500 crore for unnamed customers. There is no cover for unnamed foreign customers or suppliers. So thank you very much for hearing me patiently. I hope concepts of fire insurance and fire LOP is clear to you. Thank you very much.